Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create the infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's world headquarters in New York, and this is Bloomberg Green.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Steep losses for the U.S. stock market. The Dow, the S&P, NASDAQ all down by 3.2% or more. Right now, we've got the Dow down 1,076 points, a drop of 3.2%. S&P's down 156, drop right now of 3.6%. NASDAQ is down 661, a decline of 5.1%. The NASDAQ 100 index also lower by 5.1%. 10-year yield 3.09%. Spot gold down $6 the ounce, down 0.4%. 1874 West Texas Intermediate crude oil up 0.3%. 108.09 for a barrel of WTI. Well, the surge in stocks that followed the Fed decision yesterday proved to be short-lived, with traders worried that officials could struggle to fight persistently high inflation amid the lingering threat of a recession. S&P 500 index is on track for one of its sharpest U-turns ever. So far, we've got about 95% of companies in the S&P 500 index trading lower. Productivity was down in the first quarter as the economy shrank, labor costs surged, and illustrated an extremely tight job market. Neela Richardson is chief economist at ADP, Automatic Data Processing. She says this morning's numbers are concerning.
Productivity went down, wages went up. And so that's not the place where the Fed wants to be. They want, if wages are going up, it's because the economy is getting more productive, not because we have this super tight, unhealthy supply shortage. And I think that is the concern. Wages may not boost inflation, but wage growth can keep it around a lot longer than anyone's expecting right now.
Boeing is getting ready to fly out of Chicago and land in Arlington, Virginia. This according to the Wall Street Journal. Boeing shares down now by about 3.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Yes, indeed, everyone. This is Bloomberg Business Week on this volatile Thursday, or maybe not so volatile, because I just feel like there's just one direction in terms of the trade
It's
for
just
equities.
free fall Thursday.
It is, although we're coming off our lows of the session, but nonetheless hovering around there. It is Thursday, May 6, 2022. Carol Masser, Tim Stenovic, so much for that post-Fed rally. We're going to talk about what's going on in that equity free fall. You heard Charlie really breaking it down. More investors, though, thinking about the prospects of a stagflationary environment, tech in particular plummeting. That is really our top story. So we're going to look at the markets from a lot of different directions. We've got a great person who has seen a lot of different investment and market cycles from the VC perspective.
Yeah, longtime VC and investor Alan Patrikoff. He's back with us. We're going to see how today's environment is impacting his portfolio of companies and just what his outlook is.
Yeah, exactly. We're also going to take a look specifically at Tesla selling off a little bit more than the overall market. And this is Elon Musk seems to line up more specifics when it comes to financing for his deal.
Yeah, energy names, too, top this year, including the Williams companies amid a volatile energy market because of geopolitical concerns and, of course, the war in Ukraine. We're going to talk energy with Alan Armstrong, the president and CEO at the Williams companies.
I'm looking forward to that. Right now, though, let's get to the Market Drivers Report. Let's set your Business Week agenda on this stock selling Thursday. In the house, Kriti Gupta, markets correspondent at Bloomberg in our Interactive Brokers studio. So too is Yelena Shaletyeva, our senior U.S. economist at Bloomberg. Kriti, broad-based.
I mean, it's an incredible move. I feel like the last 48 hours, I mean, listen, I'm fairly young, surprise, surprise. So to see these kind of moves, to me, is literally like witnessing history. A historic 50 basis point rate hike, this massive rally on the back of it, taking 75 basis points off the table. And then you're also seeing this immediate reversal. And it tells you that there's two major themes here. There is inflation and there is growth. And it feels like the Fed has done decently in terms of messaging when it comes to inflation. But the growth concerns are still there. And it's not growth in the United States, it's growth in Europe, it's growth in China. And the concern here is, how does that feed into the United States? And it's all of that that's kind of essentially hitting the play button on what was a paused sell-off in the last 3 days.
Well, what changed between yesterday and today, Elena? Because we saw this relief rally yesterday when Jay Powell said that 75 basis points are off the table. But hey, that doesn't necessarily mean that we're not going to see consecutive 50 basis point rate hikes, or we could see that extra 25 basis points put in somewhere else. So what changed between yesterday and today?
I think investors are now grappling about the overall picture of inflation versus growth. So we will see some slowing in both, and it really matters how much growth slows going forward. Will we see a really bad report tomorrow for payrolls, or will we just see slowing but still solid growth in the labor market and some further improvement in labor force participation rate? So this is what the Fed is looking for, some slowing in terms of jobs growth, but at the same time, they're broadly believing that the labor force participation is coming back.
Listen, let's lay it out there. The Fed hopes for a soft landing, right? But it's very
softish.
A softish, right? But it's tricky doing this, right?
That is a word from Jay Powell yesterday. Softish. That's really important.
So softish, right? But it's not easy to do. It's not an exact science. When you look at the fundamentals and you look at a lot of economic metrics, if you will, how does the U.S. economy look over the next 6 months? Do we even have transparency when it comes to it?
I think it's possible to achieve this soft landing if you bring back into balance supply and demand in the labor market. So what the Fed is trying to do is to reduce the number of job openings, and this way to cool down the labor market a little bit. But at the same time, they are looking to see participation to increase, right. And this will move supply more into balance with demand. This way you get slower growth in wages, and this way you don't really need to fight really hard with inflation and really knock the economy down.
Kriti, this has already been a year of market superlatives, right? We have done it a lot because it's been such a volatile market, though. How does today track or trend with what we've seen, especially in that first quarter?
Well, let's start with superlatives, right? This is the biggest drop in the NASDAQ going back to September of 2020. Now, it's been 2 years since we've talked about what the issues were in September of 2020. So let me remind you, it was right before the presidential election. It was the tech wreck, as we called it back then. And a lot of the concerns was on what a Biden administration would do when it came to antitrust to some of these big tech names. And that was what was driving the sell-off. Think about it this time around. We're talking about growth. We're talking about supply chains. We're talking about a fundamental change.
It almost sounds quaint compared with what we're talking about today.
It does. But I mean, look, you have to talk about valuations as well, because given this year-to-date sell-off, you have valuations that now go back to 2020, go back to 2019, even pre-pandemic levels. And one of the big concerns you have to think about is even in 2019, before this pandemic boom in tech, before this easy money policy from the Federal Reserve, we were having the same conversation. Super lofty growth valuations, a prolonged rally driven by the Federal Reserve, not to mention the fact that we were seeing one of the longest expansions in history and decelerating growth. So the same conversations that are happening now were happening back then as well. And that's really where you have to compare the levels. The question is, who's going to buy the dip now in those concerns? Last time around, people were buying because it was a momentum trade. Stocks were going up, so why not buy? But now that stocks are going down, it's a momentum trade in the opposite direction.
Elena, last question to you. Jobs report tomorrow. We are expecting what at this point?
Some moderation in terms of payrolls growth.
We are at 380,000?
Yeah, we're around 350, and we see the unemployment rate going back to 3.5. This was the lowest level in the previous cycle.
All right, well, certainly a lot to keep us on our toes, and it'll be interesting to see after the rally yesterday, the selling today, how does that jobs report potentially impact the trade that we will get on that Friday session. You and I, as we kicked off the show, though, the S&P 500 for the week, just up a hair, up about 0.25%, but some big swings despite that overall and slight gain for the week so far.
Yes, so far.
We're not quite done, but we will be soon.
Yeah, right now the Dow down more than 1,000 points. The S&P 500 down 3.5%. The NASDAQ still down by more than 5%.
All right, let's get to world and national news for
Denise
that.
Pellegrini is in New York. Hey, Denise.
Hey there. Thank you, Tim and Carol. Well, we're monitoring the situation in Ukraine, and lawmakers do plan to pass a supplemental spending bill with money for Ukraine as soon as next week. But they face some key questions about what else should be attached to this measure. Bloomberg's Amy Morris reports from Washington.
Some Democrats want a COVID funding bill, including international COVID aid, to be lumped in with the Ukraine aid. Republicans say the funds should get separate votes, but it is possible other add-ons might be included, like a bipartisan measure that aims to ensure the U.S. collects evidence of war crimes during the Russian invasion. Senator Chris Coons of Delaware says it's still possible for lawmakers to meet Senate Majority Leader Chuck Schumer's goal of bringing a Ukraine aid bill to the floor as soon as next week. In Washington, I'm Amy Morris, Bloomberg Radio.
All right. Thank you, Amy. Tall fencing being erected around the Supreme Court this hour. Tensions building following the leak of that draft opinion signaling the Roe v. Wade decision on abortion could be overturned. Pro-choice and anti-abortion protesters converged on the building Monday night when Politico first reported on the draft and the new fence, similar to what was erected near the Capitol following the January 6th riot. And the World Health Organization says globally COVID has killed 1 in every 500 people in the past 2 years, with the total toll at 15 million, and that is much higher than previous estimates. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. And we are watching all the other stories for you here on Bloomberg Radio as well, including we're getting word that Boeing is planning on moving its headquarters to Arlington, and this will be a big difference from Boeing and also put it closer to Amazon. And we'll have more coming up throughout the afternoon. Global News, I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini there with a world and national news update. All right, we're keeping an eye on the slide in markets here. We've got just under 2 hours to go until that market close. In the meantime, we do want to mention what is the most read story on the Bloomberg in the past 60 minutes, and it certainly plays into the volatility we're seeing in the markets today and the slump.
It has to do with bonuses. Wall Street's dealmakers may see bonuses for 2022 drop as much as 40% as IPOs and underwriting businesses continue to slow. It's interesting, Carol, this story by Jenny Serene, it's not necessarily tied to a decline in the markets, but it is at the same time, because you do see when volatility is up, when that VIX does move higher, you see a decline in M&A activity, and that affects the revenue and the bonuses.
Absolutely. You see heads of companies maybe holding back to see kind of where this all lands, unless you're Elon Musk, who kind of each day seems to keep updating us on his plans in pursuit of Twitter and fine-tuning that deal. We'll talk about that in just a moment. But, you know, we're coming off this record year for M&A, so much money put to work in terms of deals, SPAC activity. That was certainly last year. Different tone. We have seen it in a big way this year. So for the first time in decades, inflation has a significant impact on real compensation and outcomes. This is from Alan Johnson, Managing Director of the compensation consultancy, Johnson Associates. He says this year's once-in-a-generation levels of inflation will weigh on pay. He put this out in a report. Rising interest rates and the ensuing increase in borrowing costs hindering deals, while volatility has sapped the market for equity underwriting. That's also a very key part of the market. And as a result, what does he predict, Tim?
That bonuses are going to fall as much as 20%. Underwriters may see drops as big as 40%. But Carol, traders, they have been feasting on this volatility. It's buoyed volume and helped revenue at Wall Street's biggest bank. Equities traders may actually see their incentive compensation rise as much as 10%. And fixed income traders, they could see jumps as high as 20%. Glad somebody's making money in fixed income.
Well, we know how this works. When there's volatility, you can make money on these trades.
Yeah.
I mean, traders, we hear it, ad nauseum for years, when the market isn't moving, they're not making money. It's hard to. But certainly this volatility has provided a lot of avenues to do just that. All right, you're listening to Bloomberg Business Week, and this is Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Just a day after notching the biggest rally in 2 years, the S&P 500 index is lower. 95% of S&P companies are declining right now. Stocks are cratering in a sharp turnabout after yesterday's Fed rally. Right now, the S&P is down 150 points, down 3.5%. The Dow Jones Industrial Average, which at one point was down 1,232 points, is now lower by 1,050, lower by 3%. The NASDAQ is down 641, down almost 5%. Again, the S&P lower now by 3.4%, down 146 points. 10-year 3.07%. Spot gold is down 0.2%, 1876 the ounce. West Texas Intermediate crude up 0.6%, 108.45 a barrel on WTI. Cathie Wood's fans are pouring cash back into her flagship ARK Innovation ETF, the growth stock fund that is starting to rebound from the steep losses seen this year. The ARK Innovation ETF pulled in $366 million on Tuesday, the biggest inflow in a year. Today, however, shares are moving lower. Right now, we've got ARK, the ARK ETF, down by 8.6%. Recapping, stocks lower, massive sell-off underway. S&P down 3.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, laying it out and really detailing all of the selling that we're seeing, this broad-based selling on this Thursday when it comes to the equity market. So, I mean, so much for the surge in stocks following yesterday's Fed decision. And here's somebody who has seen a lot of market cycles and really understands investor psychology.
We're talking about Matt Maley, Managing Director and Chief Market Strategist at Miller Tabak & Company, also the founder of the Maley Report. He joins us on the phone from Newton, Massachusetts. Matt, what is prompting today's sell-off?
Well, I think it was, the realization that not a whole lot had really changed yesterday. I mean, yes, we certainly, it was nice that the Chairman Powell basically took a 75 basis point rate hike at the next meeting off the table. But, we're still going to get, looks like at least two more, 50 basis points. And the situation with shrinking the balance sheet, we got more clarity on that. And of course, the problem, I guess, the biggest concern was the realization that what Chairman Powell said, we're trying to fight inflation, but this is a supply issue-driven inflation, which is something they can't really fight as effectively as some people might think. So there's some problems there.
Well, is it time though, Matt, for a rethink though about some of the valuations, certainly in the tech sector, or has that already been factored in? I mean, if you look at the big moves that we've seen, certainly on the tech space, do you feel like it's overdone at this point? And are you seeing indicators that maybe this is actually a buying opportunity?
Well, I mean, we'll get some bounces along the way, and if we get kind of especially if this turns into a bigger decline today, we get a nice rally at the end of the day. We've seen some crazy moves in the last hour. Yep. But once we get kind of a washout move, which I think a lot of people are looking for, and they should be looking for that because there is a lot of leverage in the marketplace, and that leverage tends to be unwound after the market kind of gets oversold, because that's when the margin calls come in. And once we get that, whether it comes today or in a couple of weeks, it should create a very nice buying opportunity. So I guess my point is that people, these things happen. When the Fed tightens, it creates headwinds for the markets. Try not to fear it. Try to embrace it, and look for that. Look to take advantage of it when you see that kind of washout move.
How is our audience going to know when to take advantage of that washout move? Because you could have said perhaps Monday or last Friday was a washout move.
Well, to be honest, you usually, I look at the volume was high, but it was not overly high. You usually like to see, like, for instance, the composite volume, like in the 7 billion shares range. MVOLNU, I believe is how you get it on Bloomberg. Sorry about that. You really want to see that huge impact of volume and breadth that is really, really bad. Like breadth when I was talking about advantages versus decliners, like 40 or 50 to 1. We've had some big volume days and some bad breadth days, but not both at the same time. Once we get that, I think that'll be a good sign that at least on a near-term basis, we're going to see a nice bounce bounce that lasts for more than just a few days.
Yeah, I pulled it up on the Bloomberg. We're way down from where we've seen in terms of volume. So that is interesting to point out. Matt, you and I have talked for years. We've seen a lot of market cycles together. How do you put this one in context, especially that, considering we have probably a generation of individuals, whether they're on Wall Street or just trying to pay their bills, that don't necessarily understand or haven't lived through really a higher rate environment, and certainly not a stagflationary environment, if that's where we go.
Yeah, exactly, Carol. I mean, we've been talking about this, like you said, for so long. And the one thing though is that we haven't had the Fed has had this Fed put on really for the most part since the financial crisis over a dozen years ago. That is no longer with us. So I mean, they're going to let things happen. Things get a little bit uglier, but. Whether it be a bear market or just another deep correction, and if we do get any kind of recession, these things are normal and they're healthy. They're actually good. They wash out some of the froth. I mean, we all know that the Fed left their liquidity spigots open for too long. Now they're adjusting to that. We don't want them to double down on their mistakes that they made previously. And so again, raise a little cash on bounces, go in defensive areas, look for hard assets during this inflationary environment like the energy sector, and kind of wade your way through it because it is going to present an unbelievable buying opportunity when the thing finally washes out.
Is tomorrow's jobs report of any consequence to what the Federal Reserve does next? If it's a really nasty jobs report, if it's a big miss, do you get the sense that the Fed will take that into account and be less aggressive with policy?
The problem is that the Fed can only handle the demand side of things. Yeah, I do think the market will see an initial bounce because people will initially think that that's what the Fed's going to do. But the fact of the matter is the real problem with inflation right now is the war in Russia because that has prolonged supply chain issues, the oil supply, food supply, and those sanctions, even if there's a ceasefire, those sanctions are going to be on for a long time. So inflation is going to be a problem. I mean, in other words, demand destruction is not going to be enough to really cool inflation. We may have peak inflation right now, but it's still going to remain higher. So, yes, I think it'll be a short-term relief, but it's not going to be something that I think people get a lot of, a big bullish move from.
Matt, real quickly, 20 seconds. Are you getting people calling you and saying, listen, I want to buy in here? Or are you getting more sell orders? I mean, obviously, I'm assuming more sell orders because of the tone of the market, but just quickly.
Yeah, I think people are very concerned here. So we are definitely seeing more to the sell side. You can see that from the breadth. The advanced decline today is really, really bad. But we are getting a lot of questions about when to buy next.
All right, good stuff. As always, Matt Maley, of course, Chief Market Strategist over at Miller Tabak, joining us on the phone. You are listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so we're keeping an eye on the market update. We'll get to Charlie in just a moment. But watching the overall major equity averages down, one stock getting really beat up today is Tesla.
Yeah, it certainly is. One stock not getting so beat up today, though, is Twitter, which is actually higher. Interesting stuff.
All right, we're going to talk about that and why in just a moment. Let's get back, though, to the overall market trade and the overall market selling. Back to Charlie.
Thank you very much. Red on the screen, Carol Massar. Tesla now down by 8.3%. Twitter up by 2.5%. More on the topic in a moment. S&P now down 166, drop there of 3.9%. At the worst level, had been down 4.1%. We've got the Dow trading very close to session lows right now, down by 1,197 points, down 3.5%. At the low of the day, it was down by 3.6%. NASDAQ now trading lower by 695 points for NASDAQ. That is the low of the day, down by 5.4%. 10-year yield 3.07%. Spot gold now down 0.3%, 18.75 the ounce. West Texas Intermediate crude up 0.4%, 108.20 for a barrel of WTI. The NASDAQ 100 index down 5.4%. Russell 2000 down 4.6%. And Bitcoin now plunging by 8.8%. So a down day for equities. Traders continue to digest yesterday's 50 basis point rate hike, with Fed Chair Jay Powell saying no to 75 basis points. Jennifer Lee is senior economist at BMO Nesbitt Burns. She was interviewed this morning on Bloomberg Radio.
Well, first I thought, unanimous. Even Mr. James, let's not rule out a 75 basis point rate hike because it's not my base case at this point in Bullard. So the conspiracy theorist in me was thinking, did they parade them out recently over the last week and sort of plant the idea of 75 basis points into the market's head and then go ahead and only, and I say only using my air quotes here, only raise 50 basis points and sort of beating expectations and thus sparking the rally, what you saw in the stock market.
Goldman Sachs, JP Morgan Chase are discussing extending abortion benefits to cover travel after an internal debate was reignited this week by the leak of that draft Supreme Court ruling to overturn Roe v. Wade. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. As we mentioned, Tesla shares, they are down about 8.5%. Conversely, if you take a look at Twitter, it's up about 2.5%. So, we are seeing broad-based in selling overall. But again, the Elon Musk, the Twitter story, it's a very specific one when it comes to the technology trade. And we did see these stocks move on news that Tesla, the co-founder of Tesla, of course, Elon Musk, restructuring his complex bid for Twitter by getting $7.1 billion in equity commitments from investors. And he also cut in half the size of a record margin loan arranged last month with an array of investment banks. It sounds like he doesn't want to put all of his money into this.
De-risking is the term that comes to mind here. Let's get Ed Ludlow's take. He's West Coast correspondent for Bloomberg News. He's standing by from our Bloomberg 960 studio in San Francisco, so you'll certainly see him on YouTube if you're tuning in that way. Ed, when this crossed early this morning, at least San Francisco time, what were your thoughts? What was your reaction?
Yeah, de-risk comes to mind, right, because the margin loan component falls from 12.5 billion to 6.25 billion, and it had a really high loan-to-value ratio. So Elon Musk put up $62 billion worth of Tesla stock as collateral on that margin loan component. So that kind of goes away. It's interesting because he still has to come up with $20 billion of equity financing of his own. He either writes a check or we'll see more partners come in. But if you just go away from the numbers, this is like the who's who list of Silicon Valley names that he's brought on board to make this happen.
So what does it say about it, that he's just got good friends in high places, or that it says there are a lot of people who want a piece of this?
Yeah, as always with Elon Musk, we're making inferences and looking for clues rather than hard facts. But Larry Ellison is close with Elon Musk, right? He's one of the biggest individual Tesla shareholders. I believe he owns about 1.5% of shares outstanding at Tesla. You have Andreessen Horowitz coming in, Mark Andreessen's a very active Twitter user. I don't know if you guys have noticed in recent days and weeks. Exactly. And he's been, poking fun and using memes to the same effect Musk does, but basically talking about freedom of speech. One that really caught my eye was Binance. Binance coming in with 500 million. does that give us a nod to where we go with this platform in terms of decentralizing it, the role of blockchain technologies, the role of cryptocurrencies on the platform? Because those are three broad ideas, but Elon Musk talked about them quite a lot on Twitter. And so we're basically looking at those names and thinking, okay, these folks are involved because they either share Elon Musk's vision or they believe in his ability to turn the platform around and make it a moneymaker.
Ed Ludlow, is this kind of like Elon reaching out to his
Connection lost.
It's interesting because there are a lot of shared relationships from Elon Musk's past. Binance is interesting because Elon Musk has publicly sort of disagreed with Binance's CEO. Mark Andreessen sits on the board of Meta, parent company of Facebook, and presumably would have a role here as well. So that puts him across the social media spectrum. A lot of really interesting people there.
Yeah. Well, one of them that really sticks out to me is Saudi Prince Al-Walid bin Talal, who's chairman of the board at Kingdom Holding Company, because
why does
Ed
that
Ludlow,
stick? Why?
I'm old enough to remember when Elon Musk went after Saudi Arabia very recently.
Yeah, so the relationship between Musk and Tesla and Saudi Arabia is complicated over time. You know, the Public Investment Fund was a big backer of Tesla, and then it suddenly wasn't. It decided that Lucid was its EV horse in the race. But even more recent than that, you know, the Prince had tweeted when Musk's stake was first disclosed that he didn't agree with the direction that things were going, and yet he tweeted again in the last 24 hours that his new friend, quote, Elon Musk, and he's clearly on board with this, and he's committed to roll over almost $2 billion of Twitter shares into this new entity. So it's a really big change of circumstances.
Well, risk reward, I guess, or, you know, people who might be kind of frenemies, but when there's money to be made, like you figure out how to get along. Hey, listen, NASDAQ down 5.4% as we speak, down 705 points. When I had to look for gainers for our cross-platform market talk, Twitter's one of them. It's up 2.5%. I mean,
off session highs.
Yeah, it's kind of interesting. Are we starting to see investors say, okay, this deal's going to happen?
Well, what I keep hearing from insiders and from market participants is that we're continually moving in a direction that's better for shareholders. There's the idea, of course, that's been reported in the last few days that even if we go private on Twitter, it will one day again go public. And so, you know, there's a lot of positive conversation around where we're going with the company, even if, you know, the deal's fixed at $54.20 a share. You look at Tesla, though, the opposite, you know, both the idea of key man risk, you know, CNBC reporting that Elon Musk is considering installing himself as the next Twitter CEO temporarily. He's a busy guy, but also Tesla's super sensitive to rising yields. We've seen that all year long so far. So there's a lot of market dynamic going on. But Twitter being up in this market, I mean, clearly there's a reason for that.
Can't you just see Elon Musk wakes up in the morning, or I don't even know if he ever sleeps because he seems like he's working. He's like, yeah, maybe I'll run it. Maybe I won't.
And maybe I'll run SpaceX. Maybe I'll run Tesla. Maybe I'll run the Boring Company. Maybe I'll run Neuralink.
Remember,
maybe I'll run Twitter.
Didn't he talk about getting into mining too? And didn't he tweet out
about commodities,
right?
for sure.
Right, Ed? Didn't he tweet about commodities?
So he basically said, if you want to get rich, get into lithium mining because the markup right now is incredible. Yeah.
I'm just saying, like, he throws a lot of stuff out there. Anyway, we're definitely seeing market reaction. Ed Ludlow, he's our West Coast correspondent at Bloomberg News. You could see him on YouTube.
From the West Coast to the East Coast, let's get a check of the latest world and national news. Denise Pellegrini standing by in New York. Hey, Denise.
Hey, Tim. Well, word is coming in that some Wall Street bonuses may be about to drop. This is a word from Alan Johnson. He's managing director of the compensation consultancy Johnson Associates, and he says bonuses for some deal makers could plunge 40% this year as IPO and underwriting business slows. Of course, traders could see a big jump in bonuses as they feast on volatility like what we're seeing today. It's Hurricane Preparedness Week. Federal, state, and local officials encouraging us here in the eastern U.S. to get ready for the official start of the Atlantic hurricane season June 1st. Ken Graham, director of the National Hurricane Center, saying recent storm seasons are just getting worse.
We've had more Hurricane Cat 4 and 5 landfalls in this country from 2017 to 2021 than we did from 1963 to 2016.
And Graham also warning there's no such thing as just a Category 1 hurricane. He says flash flooding kills many Americans, mostly in their cars. 2020 was the most active season on record, 30 named storms. 2021, the third busiest. And grab the Kleenex because allergy season is now 20 days longer. The pollen count has increased significantly compared to 1990, and allergists, including Dr. Nita Ogden, say it's also impacting people who just never had problems before.
People complain about symptoms being more intense than ever.
And Nita also says researchers blame the increase in intensity on climate change. And they say if global carbon emissions continue at this rate, the U.S. can expect an even longer and more difficult allergy season in the future. I'm Denise Pellegrini, and this is Bloomberg.
Thank you so much, Denise Pellegrini. You are listening to Bloomberg Business Week. Carol Massar, along with Tim Stenovic, we're watching certainly the overall equity market trade. We are bouncing near our lows of the session, kind of leveling off, if you will. S&P still down 3.8%. Dow Jones Industrial Average, a decline of almost 1,200 points, down about 3.5%. NASDAQ down about 5.25% for a decline of about 684 points. So we talked a little bit about Elon Musk just a moment ago.
Yeah, he was busy tweeting, too, over the last 24 hours in conversation with Cathie Wood. By the way, I saw her several times at Milken this
she was
week.
Was
that last week or this week? What week is it?
That
was 2 days ago.
Yeah, we were there.
We were there. Okay. And now we're back. Elon Musk and Cathie Wood criticizing passive investing in a Twitter thread, weighing in on a long-running Wall Street debate about the growing power of index funds. This is something, Carol, that you and I talked at length about with Cathie Wood just a few weeks ago.
Yeah, this discussion was sparked by venture capitalist Mark Andreessen, who said firms like BlackRock have outsized voices in many corporations because of the voting power attached to their huge passive vehicles. Musk, of course, you know who he is, replied that passive investing has, quote, gone too far. Wood, who founded ARK Investment Management, took up the conversation, noting that investors in S&P 500 trackers missed out on big gains in Tesla before it was included in that index. So basically, blindly, if you're just buying the index, right, there's no active management. She is an active ETF, and that's her point.
Full disclosure.
Yeah, full disclosure. But saying the point that you're going to miss out on some of these innovation trends that might not be interesting, engaging, or profitable early on. And certainly if you're just buying the index, you're going to miss those opportunities.
That is exactly what she spent a good portion of our interview with her a few weeks ago talking about, Carol, that the idea if you're buying an index, you're not necessarily seeing those companies that are not yet part of the index. And she says that these indexes are underweighted disruptive technology, disruptive innovation. And that's what ARK Invest is all about.
Yeah, well said. And just taking a look at ARK Innovation, it's down about 9.5% today, down 45% so far this year. But her fans are pouring cash back into her flagship ARK Innovation ETF. The growth stock fund that is starting to rebound from the steep losses this year. It pulled in about almost $367 million. That happened on Tuesday, the biggest inflow in a year.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are cratering. We are bouncing along the bottom. Steep losses for the Dow, the S&P, NASDAQ 100 Index, and the Russell 2000. The S&P down now by 161 points, down 3.7%. Just about 95% of companies in the S&P 500 are moving lower. The Dow is down 1,172 points now, down 3.5%. NASDAQ is down 679. The NASDAQ Composite Index down 5.2%. The NASDAQ 100 Index lower now by 5.3%. 10-year yield 3.06%. Spot gold is down 0.2%, $18.76 the ounce. Bitcoin plunging 8.5%, and West Texas Intermediate crude is up 0.5%, $108.31 a barrel. Traders are worried that officials could struggle to fight persistently high inflation amid the lingering threat of a recession. Lots of companies will report earnings after the close of trading today. Among some of those names, Zillow, Shake Shack, DoorDash, and Cloudflare. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic, and of course, Charlie breaking down what we're seeing in the market trade today. We're keeping an eye on that. We're also keeping an eye on the cover of Bloomberg Business Week this week, which happens to also be today's Bloomberg Big Take. It is among our most read on the Bloomberg. Maybe everybody looking for a little break from all of the selling, Tim.
Well, it's the fact that F1 exploded in popularity over the last couple of years. So if you write something about F1, people are going to want to read it, especially in this day and age. Joining us now is Austin Carr, technology reporter for Bloomberg News. He joins us on the phone from Boston. Austin is the author of the cover story of this week's issue of Bloomberg Business Week magazine. Check it out now on newsstands on the Bloomberg and at bloomberg.com/businessweek. Austin, great to have you with us. How did Formula One finally find a way to get Americans to care?
I think the simple answer is that F1 for a long time had been closed off to new audiences.
I thought you were going to say Netflix.
Netflix would be a very simple answer, and we can talk a little bit about that. As you noted, one of the big impulses for people watching F1 these days is a Netflix show called Drive to Survive. But what that's actually all a part of is the transformation of the sport from sort of a closed-off, pretentious, exclusive sport that's synonymous with European audiences to something a little bit more Americanized, which might not be as highbrow anymore, but it's still keeping that cachet, the insanely fast cars, and trying to be open to new audiences with sort of Super Bowl-like entertainment. This is something that has happened over the last 5 years under the ownership of Liberty Media, which you might know because they own the Atlanta Braves and also Sirius XM Radio. And they've really been trying to take the sport and just open it up to new markets and also new distribution channels, like you said, Netflix or social media and so forth.
So I'm going to ask the really hard question because, Austin, every time we have you on this show, we learn about hot sauce, daiquiri machines, what you do, Buffett report, Margaritaville reporting.
Finally living up to his last name.
And what I really want to know, Austin Carr, how many hours of F1 did you watch to get this story right?
And of course, that is Joel Weber, the editor of Bloomberg Business Week, joining us. Go ahead, Austin.
It's a good question, Joel. And in fairness, I was doing that before I pitched the article. So I wouldn't say I was doing it on the clock at work. But I have spent a lot of time watching this. I would say I'm part of that target demographic that was into motorsports but had never really quite been interested in F1, partly because it was so complicated. This is a sport where teams like Ferrari and Mercedes spend hundreds of millions of dollars on these machines that are really something only 20 or 30 or 40 people in the world have ever actually driven, at least in a real race. They go up to 220, 230 miles per hour. When we think about NASCAR, mostly those cars are all all the same and mostly racing on ovals, whereas, the big thing about F1, there's a lot of turns. It's a big circuit. They're often street races through Monaco. And so just in terms of making sure a lot of that technicality, the really feats of engineering, the logistics of the sport translates to new audiences, one of the big things that Liberty did and what got me interested in the sport for sure.
Okay, so you've spent $4 billion and change buying F1. Like, one of the things that's interesting to me is, like, you think about an NBA franchise, the Clippers sold for $2 billion. Four is not that much more than two, and it seems like you could actually, if you could grow this audience, you could grow the investment, right? Like, how is it breaking down on the business side?
On the business side, I think that's one of the things Liberty saw. They as I said, they own the Atlanta Braves, which is only a team. This is them buying an entire global league. If you think about, there's not that many leagues out there that have that global reach. You think about the Olympics, FIFA, but as one of the Liberty media executives told me, you can't go and just buy the Olympics. But with F1, here they came across this asset which was put up for auction in around 2016, and it really hadn't been sort of tapped into these new digital options. There was no social media presence. A lot of the drivers were sort of kept under the helmet. They weren't celebrities in the same way as you'd expect in the NBA or MLB or NFL. And so Liberty came along and they took over the sport and were trying to get rid of what the former owner, Bernie Ecclestone, said was he used to run things like a Michelin restaurant, not a hamburger joint. And I think what they've tried to do is try to balance that between serving a few burgers while trying to keep those Michelin stars. So in the business side, they've actually, since the F1 stock, it trades as a subsidiary of Liberty, it's actually tripled in the last 4 or 5 years. And the audience itself is up cumulatively, or on a unique basis, to about 455 million people around the world who tune into one race a year. And so it's really growing, and especially in America, where you're seeing it take off with Netflix.
I love how you put that with hamburgers and a Michelin star restaurant. And I just wonder how, with the United States exploding in popularity when it comes to F1, Austin, how F1 and Liberty prevent this from becoming NASCAR-ified.
So I was down, I spent time in Texas. I went to this Texas race, which was pretty remarkable last year, not just because they had performances by Shaq or they had a spam eating competition, which may sound a little bit lowbrow, but they also had performances by Billy Joel.
Wait. Spam, lowbrow? Come on.
Well, I didn't, if that's your cup of tea, I hadn't realized that. I mean, that could be the next sport that I write about, Joel, just heads up. But
I'll wait the pitch.
I went also down to Miami to see the new track, which is all around the Miami Dolphin Stadium, and it's trying to balance that sort of highbrow and lowbrow and sort of be a sort of.
Wait the pitch.
I went also down to Miami to see the new track, which is all around the Miami Dolphin Stadium, and it's trying to balance that sort of highbrow and lowbrow and sort of be a sort of universal in its approach. So they do have, you can watch the game, the race from the top of the football stadium for a lower price ticket, or you can even spend thousands of dollars to sit in the back of a yacht, which they had trucked in, and they painted planks to look like water, so they have sort of a Monaco-like yacht club
Can you
marina.
just linger on that for a second?
There's the spam element.
They paint the parking lot blue to make it look like waterfront. I love that.
It's just
that's at Turn 7, which when I was down there it was the whole track, which is it's 3 to 4 miles of circuit all around the stadium, and they were building it while I was down there, and it's transitioning from this sort of parking oasis to semi-upscale racetrack, and so they literally trucked in all these Sunseeker cruises, which are sort of small yachts, and then built out. They set them up on stands and sort of docked them. At what looks like
you can't make it up. Okay, Austin, Bernie being the guy who owned this sport forever, last thought, how does he feel about all of this?
Bernie Ecclestone is a fascinating character. He's 91 years old. He invented the sport, built it up sort of in the 1970s through the 2010s.
Right.
And he brought that sort of pretension to the sport, but also made it very luxurious. It's synonymous with champagne under Bernie. And I think the one thing he said is I think he said to me that, this may well be good because everything that comes out of America makes people happy, but it wasn't the way I ran things, and it's pretty stupid. So I wouldn't say he's totally happy yet, but he does want the sport to keep growing, and we'll see how he thinks about the Miami race and whether he buys one of the yachts down in Florida.
It's a great cover story. Our thanks to Austin Carr, tech reporter at Bloomberg News, joining us, along with Jill Weber, editor of Bloomberg Business Week. We will await the cover story on spam. More to come on that maybe in the future. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes left in the trading session on this Thursday afternoon. Romaine Bostick, Taylor Riggs, Katie Greifeld, joined right now by our colleagues Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, as well as on YouTube. And Carol, yesterday we had a 3% rally on the S&P 500, a huge re-rating and reassessment today as we're down almost 4% right now.
Yeah, so much for that, right? And we're hovering near our lows of the session. Matt Maley of Miller Tabak was just on with Tim and myself. And one thing he said is, yep, we are down across the board, broad-based selling, but take a look at volume. That is also down, and that might give you some hope in terms of maybe are we bottoming out and that not all investors are throwing away everything.
Well, there's not really anywhere to hide today, including in crypto. Bitcoin down more than 8% as we speak, dropping the most intraday in about a month, lowest levels since mid-February, Taylor.
You're certainly seeing a day of superlatives. The S&P 500 having its biggest one-day drop since June of 2020. NASDAQ, biggest one-day drop since June of 2020. And the NASDAQ 100, the biggest one-day loss, roaming here since March of 2020. So really sort of a big day, Katie, when we think about some of the downside risks that you've had to these equity markets. The NASDAQ 100 now bringing us all the way back down to the lows that we haven't seen in about a year.
And that big drop in the NASDAQ 100, you can see that mirrored on a sector level. If we look at the S&P 500 sectors, 11 of 11 sectors down. You have consumer discretionary way down there at the bottom, some of those e-commerce names, technology right after that. And again, I mean, every sector is down, but utilities, a little bit of a defensive tilt there. That is your least bad option today.
Yeah, and it's interesting, too, because when we talk about what's defensive here, we know that some of those tech stocks had provided a little bit of a ballast in the past, not necessarily getting that today. Apple, of course, one of those fallback defensives, down more than 6% here on the day. Amazon moving lower as well, down about 8%. And then you got a tale of two food companies here, and I thought this was interesting. You have Sprouts Farmers Market down 25%, biggest slide that we've seen on that stock in history here. That company talked about its fundamentals, not only dealing, of course, with higher costs, but actually said it's starting to see maybe a potential softness in actual consumer spend, at least the amount that they're spending per visit to the store. So something to keep an eye on there. Meanwhile, Kellogg, though, saying, well, it's managing some of the supply chain issues just okay here. Of course, that does include raising prices, but is also saying that some of the supply chain issues that had actually limited what it could put on the shelf, it's now finally starting to work through that. So interesting to see how these companies are navigating. You're seeing Kellogg shares up 3.5% on the day.
Romaine, I know that the next chart to look at is a little bit difficult sometimes here visually for the TV audience, but it is the big drawdown that we've had from some of the recent highs here on technology. And Carol, what it does show is we're down about 25% from some of the latest highs on tech. I think what is interesting, though, is we were speaking with Gina Martin-Adams over at Bloomberg Intelligence earlier, and the forward PE ratios have come down a lot. And I said, well, what happened, right? If those look attractive relative to where they were in 2020. And she said earnings and the revisions lower is exactly what happened that really made us, again, rethink a lot of the valuations for these big tech companies.
Yeah, right. We're doing this recalibration, this rethink in terms of valuations. What are we willing to pay for some of these names, especially if the outlook isn't so great? Speaking of the outlook, we did get one data point that was a bit of a shocker. U.S. productivity dropping the most since 1947. So the question is, and this is something we think about when it comes to the U.S. Central Bank, can they engineer a softish landing? And the head of rate strategy over at BMO Capital Markets, Ian Lincoln, he weighed in on that. Here's what he had to say.
I think that at this stage, the market is dismissing the probability of a soft landing almost in wholesale terms. We're effectively saying we're going to over-tighten. The question is, when do we actually see a recession? And when does the Fed subsequently need to cut rates in a fine-tuning give back from however far they're able to normalize policy rates?
All right. Again, the head of rate strategy over at BMO Capital Markets. So, I mean, this doesn't come as a surprise, right? We've all talked about that it's very difficult when you're coming out of a cycle when the Fed is being aggressive, Tim, for the Fed to get it right and engineer that soft or softish landing.
And Matt Maley reminded us over at Miller Tabak that a recession is a normal part of an economic cycle and that it's normal to see froth taken out of markets.
Okay.
And, you know, easy for someone to say, not necessarily, but it doesn't mean that it's not stressful times and we don't see a lot of volatility around it.
Okay, well, what's the role of the Fed in this? Because you keep talking about the Fed, you keep talking about whether we get this quote-unquote soft-ish landing. So we've gone from soft to soft-ish. At some point, I assume we're just going to flip to, you know, just crash and burn. But at the end of the day,
Jay
this
Powell,
is a market.
right?
He said softish.
No. And then we talk about this idea of whether the Fed is really looking at financial conditions, whether it's really looking at risk assets and thinking to themselves, we need to sort of provide a little bit of a ballast there. And I think that what's been made clear here is that ballast isn't there, at least not at 4,100 or wherever we are right now in the S&P 500.
Well, Romaine, I spent all morning talking to strategists and investors about that point, about financial conditions. How much is the Fed actually looking at them? Because Powell made the point that that is how monetary policy touches the economy. It's through the tightening of financial conditions. And honestly, I mean, they're still at, 2018 levels? They're not tight enough to the point where this would cause this Fed to blink. At least that's the message that I've gotten today.
I think one thing I don't understand is, at least on tech now, we're off 5.5%, 5.6%. So we've wiped out all the post-pandemic gains. We're back to lows that we haven't seen since November of 2020. But Carol, the economic picture, at least here in the U.S., is starkly different than where we were in the depths of COVID. And is this just a yield story? Is this just a rate story? Is this a market that's really looking forward and really forward-looking to a recession that could be 12 months away? way, I just can't quite understand sort of the big losses of today.
Well, and I think the concern is it's not just recession, but it's stagflation, right? Do we ultimately go into an environment where it's slow growth but higher prices? That would put a squeeze on so many Americans, much more so, and that, potentially without the assistance that we've seen during the pandemic, and that's where it starts to become very, very problematic. And I guess what we need to watch, what do we get in the jobs report? What do we, as we come out of this earnings cycle, what do we see in terms of companies continuing to cut back, whether it's on capital expenditures or whether it's on hiring? That's when it starts to really impact, a lot of Americans, and then ultimately play out in consumer spending and everything else that goes along with it.
Yeah, but to a certain extent, the Fed only has control over the demand side, not over the supply side. Right. And that's an issue when it comes to the inflationary pressure that the Americans are seeing right now and that the world is seeing right now. So the Fed can continue to raise interest rates.
But isn't the logic that a lot of these supply chain issues are a direct result of the demand side of the equation? And these economists, and all these smart economists basically say, well, if you sort of dampen down the demand, then that maybe solves the problem. Maybe it does, but the question is, can you do that without the collateral damage?
And I would say coming out of Milken, one of the things that I got is that people were saying, because I'm like, is this just all pandemic? And they're like, no, these are things that were changing structurally, whether it's chips, whether it's other commodities. These things were changing. We're going through structural changes, and it's going to be uncomfortable for some time.
Were you at Milken too?
I don't know. I barely saw you.
I missed you the last day, yeah. Okay.
I know. I missed you too. We didn't even have a drink together.
No.
Around the pool.
Not tonight.
Well, I had 2 for you on your
I had no alcohol. It was really depressing. All right, we got to run. We'll be back in less than an hour's time. We're going to count you down onto what is a certainly risk-off equity trade. We are certainly seeing that. We'll count you down to the closing bell on this Thursday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I don't think your mic is on, Carol.
Hello,
but it's
hello,
Bloomberg
hello.
Business Week. Carol Masser and Tim Stenovic live in the Bloomberg
everywhere.
Interactive Broker Studio in New York. Carol, markets are still lower.
Yep, we're pretty much going now towards our worst levels of the session. So what does it mean, everyone? S&P 500 down 178 points, down almost 4.2%. 41.21 is the last print. Dow Jones Industrial Average down 1,259 points, down 3.7%. And the NASDAQ really the underperformer, as we've often seen in these volatile and down draft days, down almost 5.7%, down 736 points at 12,228. I want to point out the VIX. It is up 6 points to 3148.
Remarkable, Carol. Right now, the NASDAQ having its worst day, the NASDAQ Composite having its worst day since March 16th of 2020. That was, of course, the COVID-related sell-off. And then the lowest is at its lowest point now since November 30th of 2020.
All right, so what does this mean for the bond market, right? It's so smart to look at both of these and see if we're seeing similar trades. What's interesting is yields are staying higher. So we've got the 10-year note at a yield of 3.05, almost 3.06. Looking at the shorter end of the yield curve, we're looking at a yield of 2.71. So holding on to their high. So what we're seeing is investors selling stocks, selling bonds, yields staying higher, and that makes sense coming off of the Fed yesterday.
Well, let's get an update when it comes to world and national news. Standing by in the newsroom here in New York City is Denise Pellegrini. Hey, Denise.
Hey there, and we're getting word from former Defense Secretary Leon Panetta, who says the war in Ukraine is now in a stalemate. And the question, of course, is for how long?
It could go on for a period of time. The other option is that it can produce some kind of negotiated settlement, but a lot of that's up to Putin, and I don't see that happening. And the third is it could escalate. So we are in a very critical stage of this war.
And Panetta also saying because of that possibility of escalation, we need to be extra vigilant in the U.S. right now. Intense fighting in Mariupol this hour as Russian forces attempt to wrest control of the Azovstal steel plant. And that's ahead of next Monday's planned Russian military celebration in Moscow. On Wall Street, Goldman Sachs and J.P. Morgan Chase considering extending abortion benefits to cover travel to their employees. We heard earlier from Jamie Dimon, CEO of J.P. Morgan, on the controversy.
I think it's a mistake. These things are very complicated. And, when people pass laws everywhere, there's actually 100 things in the law.
Costs, right?
No, it's not. Sure. There are 100 things in all these laws. 100. And so when people say support this, support that, all you're doing is being sucked into support something you probably shouldn't. I've looked at all the voting laws, I've looked at all these laws, and you look at them, I agree with some of the things they say, I don't agree with some of the things they say. New York does a better job than Georgia. So I'm not going to get sucked into saying I support your law.
And Diamond also saying the bank will take care of its people, and Citi is already offering the abortion travel benefit for its employees. And we're getting word that Boeing, of course, a big defense contractor, is expected to move its headquarters from Chicago to the Washington, D.C. area. Global news 24 hours a day and on Bloomberg Quick Take. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. We're keeping an eye on the markets. So, too, are so many market watchers. And we've got a story that just got a read spike on the Bloomberg terminal.
Yeah, it's about ex-Fed Vice Chair Richard Clarida saying that rates must rise to at least 3.5%. That's what he said. Here's what he said in a quote, okay? Expeditiously, quote, expeditiously getting to neutral will not be enough this cycle to return inflation over the forecast horizon back to the 2% longer run goal, he said in remarks prepared for delivery to a Hoover Institution conference on Friday. He continued, quote, the funds rate will, I believe, ultimately need to be raised well into restrictive territory by at least a percentage point above the estimated nominal neutral rate of 2.5%.
All right, so when we talk about nominal or neutral rate, right, it's not, restrictive, nor is it stimulative, right? That's what the Fed's trying to do. And, right, I mean, Jay Powell did say
Just
softish
floating there,
landing,
right?
didn't he?
Just
He did
floating.
say softish?
He absolutely
Okay,
said softish.
just check it.
I was making a joke yesterday about it, Carol. I said, what comes between soft and what's softer than hard but harder than soft?
Softish. So, all right, but this is the tricky part of the Fed getting it right. And, all seriousness or all frivolity aside, I mean, it's not an easy thing to do. And so we are hearing lots of conversations that, whether or not this new rate, the new normal will be above what the Fed has normally done, as Clarida is saying, the nominal neutral rate of about 2.5%. He's saying it's got to be maybe a full percentage point above that.
Well, we're at such a different point in inflation than we have been in 40 years. So what worked and what was a neutral rate that we were used to isn't necessarily going to work.
Right. And I think it really does speak to, I think about this woman, an executive over at Intel, and just saying, listen, because I said, is this just pandemic related? And she's like, no. I mean, more and more stuff that goes into cars is chip related. More and more stuff that goes into everything is chip related. And so these structural things were happening, and there's going to take some time for adjustment to happen. And it's not something the Fed can fix. It's just world dynamics,
Just
globalization.
going to say it again, supply chains.
Right, and just, kind of adapting to the new normal in terms of new global demand. All right, you are listening to Bloomberg Business Week on Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lows of the day right now for the Dow, the S&P, NASDAQ 100 index. The selling continues. 43 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are plunging today, reversing yesterday's gains, with the Dow currently down 1,300 points. S&P's dropped 187, while the NASDAQ is lower by 764. The U.S. 10-year yield at 3.06%. Gold is down 3. Oil is in the green. And Bitcoin is down by 9%. Among the main 11 S&P sectors, all were in the red, led by losses in consumer discretionary, tech, and telecom. Leaders to the upside in the Dow all were in the red, led by 8% losses in Salesforce. After earnings, Etsy fell 18%, Shopify plunged 15%, and eBay dropped by 12%. In deal news, Max Linear to buy Silicon Motion in a cash and stock deal. In other news, Europe's junk credit risk climbed to the highest since May of 2020. Wrapping things up, some of the names reporting after the bell tonight include McKesson, Monster Beverage, and Shake Shack. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. Fast-moving markets, and to hear live breaking news over your Bloomberg-type Squawk SQUAWK on your terminal, I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Really appreciate that update on the markets. Folks, we are, as Charlie mentioned, our indices, major equity averages at their lows of the session. That NASDAQ just down about 5.9% as we speak. Really nowhere to hide in today's market environment. That includes even the top-performing major industry group in the S&P 500 this year. We're talking about energy, which as a whole is up more than 40% year to date. One of the outperformers in that group, shares of the energy infrastructure company and pipeline operator. We're talking about the Williams companies, which is up nearly 40% so far this year, at least as my last check. A bunch of analysts recently raising their price targets on the company. So let's get into the business and the outlook. Luckily for us, Alan Armstrong is in our studio as president and CEO at the Williams Company, as we mentioned, here in our Bloomberg Interactive Brokers studio. How are you?
I'm great. Thank you very much.
But you're glad to be not a big tech company or something like that. Talk to us about the outline. You are a pipeline operator. That provides you, what, some insulation in terms of some of the volatility?
Sure. You know, we're really in the business of transporting. We actually connect the very largest basins here in the U.S., natural gas basins. We connect about 15 different supply basins into the very best markets here in the U.S. And so with our Transco system, we serve all up and down the eastern seaboard, really coming out all the way starting in Corpus Christi, Texas, all the way through Atlanta, Charlotte, D.C., Philadelphia, all along the eastern seaboard. And then in the Northwest, we serve all the major metropolitan areas in the Northwest, including Seattle and Oregon as well. And then we serve the Florida markets with our Gulf Stream pipeline. So we really are in the very best spots for growth and demand here in the U.S. and serve most of the LNG export facilities here in the U.S. as well.
All right, we'll have a lot of export questions too. I want to start though with prices and just your outlook for prices this year. Where do you see them going, given that natural gas prices have more than doubled so far this year?
Yeah, you know, really the challenge for price, it's really interesting. You see the price of gas in Europe, and of course has gotten extraordinary and could go even higher depending on where things go on that front. But here in the U.S., you're seeing prices in the $8 range versus the $30 range and plus that you're seeing in Europe. And the reason for that is lack of infrastructure. It's not any more complicated than that. We have plenty of low-cost supplies here in the U.S., and we have the ability to grow our supplies here in the U.S., but the U.S. producer is not going to continue to produce gas when there's not incremental takeaway capacity. So, for instance, take a Marcellus and Utica producer, and they were counting on the Mountain Valley Pipeline being completed, which would have been a nice, attractive market outlet for their gas. Once that project got stopped, they had to slow their drilling down. Otherwise, all they were going to do is just compete against each other for the same market outlets, and the price would drop dramatically in that inter-region basin. And so they are very, very dependent on infrastructure. It is not as complicated as people want to make it. It truly is just about us having enough export capacity and having, in the way of LNG facilities, and having enough pipeline infrastructure to get it to those incremental markets.
What is the outlook for exports, considering what's going on with the war in Ukraine and really Europe rethinking, who's going to be its energy partners going forward?
Yeah, well, a lot of great progress has been made here in the last 3 or 4 months on contracting for export facilities. And Venture Global's new facility came up at the Calcasieu terminal earlier this year. That's the latest of new capacity to come on. And there is a lot of new contracting that's being done right now.
Contracting mean being talked about?
No, contracting in terms of people actually signing contracts for the capacity. That's the good news. The bad news is that simply starts the process for permitting and constructing the facilities. Now, the good news is there's a lot of facilities here in the U.S. that are already permitted, but even with that, you're talking about a 2.5 to 3 year, even on a fast cycle, to get that LNG export facility built. And so the export facilities are one of our big challenges.
Is that, though, the long-term play? No doubt about it, because of that war in Ukraine?
Well, I would say actually that kind of supercharged the issue, but if you think about it, before Ukraine came along, Europe already had its energy crisis. Recall that Germany had shut down a lot of their nuclear facilities and their coal facilities, relying on wind. They had a low wind resource year, and as a result of that, they were running very short on natural gas. That was all before Ukraine came along. Ukraine has added, so the first part of that was,
so this was already happening in
this
terms
was
of
absolutely already.
Partnering or contracting with the
The prices had already gone there.
Okay.
But then the turn to the U.S. was then very much focused around the Ukraine, because remember, you had Nord Stream 2 that was going to come on to provide incremental supply. That was a Russian supply, obviously. And so once that project got stopped, there needed to be incremental supply coming out of the U.S. And so, as I say, it kind of supercharged the issue, but the issue of being short natural gas in Europe had already presented itself ahead of the Ukrainian crisis.
So what's a realistic timeline about when we can see meaningful production increases of natural gas here in the United States, given the infrastructure challenges you highlighted?
Well, the three primary areas for supply are going to be, in this order, are going to be the Haynesville, the Texas and New Mexico Permian supplies, and then the Marcellus and the Utica. The Marcellus and Utica are by far the largest and the highest potential for long-term resources that we have. But the reason the Haynesville is first is that it's in Louisiana, and it is where a lot of this incremental demand for LNG is building up. And so you can build pipelines in Louisiana without having to have a federal permit. And it is the federal process that has really stymied the ability to get the infrastructure built. And so that is why you're seeing the Haynesville be the place that you're seeing a lot of rigs attracted to in the gas supply industry and the pipeline infrastructure, just because of the differential in permitting process.
Alan, we'd be remiss to not address the volatility that we're seeing in the market environment today. And we are seeing a lot of selling, certainly on the equity side, lots of talk about stagflation, concerns about the Fed missing it when it comes to a softish landing, which we heard from Jay Powell. How do you see it? What are you seeing from your customers that tell you what about the economy for the next 6 to 12 months? I'm not quite sure what visibility you might have.
Yeah, well, sure. If you think about who our primary...
I mean, you did raise your CapEx. I mean, you guys are optimistic.
Yeah, well, so if you think about who our customers are, on the one hand, it's natural gas producing customers, and on the other hand, it's the demand side, mostly utilities and LNG customers. So those are kind of our primary sets of customers. And
Chesapeake, Lockheed Martin, these are all customers?
Chesapeake is a big customer of ours. The Southern companies, Duke, Dominion, all of the big utilities, Con Ed here in New York City. So those are our big customers. And I would say on the utility side, they are absolutely stuck on and moving ahead with natural gas and converting a lot of the coal as they look to a very complementary source of fuel with renewables. So lots of investment on renewables, but knowing that they've got to have strong backup capacity for those facilities. If you think about it from a Williams perspective, we sell capacity. We don't sell the actual molecule, we sell the capacity. And so if somebody is putting in a power generation facility, they can't just buy for the utilization rate times the capacity, they have to buy for the full capacity. So we have a tremendous amount of demand for incremental projects. We have 6 projects under execution right now.
Is that a lot from what you've had historically?
So that's 1.9 BCF a day.
Yeah.
That's about 2% of the U.S. Demand today. And that's just what we have in execution. We have 25 other projects that are in the development stage right now.
Well, such a delight to have you here in studio. Thank you so much. I know you're going to join some of our TV colleagues to continue the conversation. But Alan, thank you. You're welcome back anytime.
Thank you very much. Glad to be here. Thank you.
Pleasure. Alan Armstrong, he's president and CEO at the Williams Companies here in our Bloomberg Interactive Brokers studio. And as we talk about, if you look at the major industry groups in the S&P 500, it really is those energy names that have been the outperformers certainly this year and last year.
Well, speaking of the S&P 500, we are just around session lows right now. Let's go over to Charlie Pellet for an update just about a half hour before the close. Hey, Charlie.
Indeed. 32 minutes to be precise, Tim. The Dow, the S&P, NASDAQ very much in the red, as you correctly point out. Session lows right now. Do want to begin with hydrocarbons, though. We've got oil stocks for the most part lower. ExxonMobil, for example, down 2.4%. BP down 2.6%. Chevron tumbling now by 1.8%. Natural gas up 3.6%, 872 per million BTUs. And a barrel of West Texas Intermediate crude up 0.4% right now, 108.21 for a barrel of WTI. Boeing is confirming its plan to fly out of Chicago and land in Arlington, Virginia. Will be relocating from Chicago. Boeing shares right now are trading lower by 5%. S&P down 191 points, down by 4.5%. We've got the Dow down 1,348, down 3.9%. The Nasdaq Composite Index down 772 points, down by 6%. Broad-based selling right now. We have also got the Russell 2000. It is down by 5.1%. Bitcoin selling off as well. Bitcoin now down by 9.8%. The 10-year yield 3.04%. Wall Street continues to digest yesterday's 50 basis point rate move, along with remarks from Fed Chair Jay Powell. Lisa Hornby is with Schroeder Investment Management.
The irony yesterday is that Powell increased rates 50 basis points. They announced that they're going to start QT soon. And yet they actually loosened financial conditions on the day with the market moves. And I don't know that was entirely intentional, but that is a big shift, right? They're taking off some of the very, very hawkish rhetoric, at least in the near term. And I do think that it removes the probability of a Fed-induced policy recession for at least the time being.
ConocoPhillips, one of North America's biggest energy explorers, has added another $2 billion in capital it plans to return to investors through share buybacks and special dividends. ConocoPhillips lower now by 1.7%. Recapping stocks selling off, sharp losses now with the S&P down 4.5%. Keep it locked into Bloomberg Radio right through the close to see how we wind up, and also, of course, how Asian markets tonight. We've got you covered on Daybreak Asia. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And just a reminder, we got to rehash it. S&P 500 down about 4.5%, down 191 points. The Dow Jones Industrial Average, a decline of nearly 4%, down 1,354, so 1,354 points. And the NASDAQ, it is a decline of 6%, down 776 points. We are at our lows of the session.
Let's get into it with Vince Signorello, global macro strategist at Bloomberg News. He joins us on the phone from White Plains, New York. Vince, good to have you with us. The question I've been asking myself, and anyone who will take my questions throughout the day, is what changed from yesterday's rally to today? By the way, the good news is people have to answer my questions. Or they have to let me ask them, I guess.
We'll
Vince,
see if Vince answers.
What's your take on this, Vince?
To be perfectly honest with you, and I know this sounds ridiculous, nothing has changed. We're simply reacting, I think, as we probably should have reacted in the first place. What drove that rally yesterday was something as silly as Powell pushing back from 75 basis point rate hike to 50 basis points. And I think the machines got took of it, started to drive it higher, and we just saw a very, very difficult short squeeze in the markets that just took people out of positions. And now, after what we heard from the Bank of England this morning, I think is what's driving this is they poured cold water on everything the Fed said yesterday by basically saying if interest rates go where we think they're going to go, unemployment's going to go up about 2%. We're going to lose about 600,000 jobs, and the economy's going to stagnate. And everyone went, wait a minute, if that's going to happen in the UK, it's probably going to happen here too.
Yeah.
And I think that was the real catalyst. I mean, yesterday we were way overdone on the upside. I think we're a little bit overdone on the downside today. But once again, what I would point out is we keep seeing this pattern of one day up, next day down, but net, the sellers are still taking a bigger chunk out of the market than the buyers are able to put back in. So the trend is obviously decidedly still way lower.
But I mean, the big worry here, right, is that we've got some slowdown in the economy, whether it's people not finding jobs, people not getting wage increases anymore. I mean, it's barely there, I think, to begin with, right? Kind of-ish. And then what does that mean for consumer spending? And of course, the U.S. economy is so reliant on that. And then so what kind of a slowdown do we have, and how protracted is it in an environment where we still are paying so much for everything because inflation stays high?
I think that, unfortunately, is largely on the Fed. The Fed is trying to raise interest rates to quell inflation when inflation is being driven by, number one, supply, lack of, and also energy and food. All of those things the Fed has absolutely no control.
Thank you. This is what I've been saying for the last, 3 months.
And I'm going to say something that some people are going to think is dumb, but having watched the Fed for over 40 years, maybe closer to 50, I'm telling you the Fed is making a drastic error. I mean, they're raising
In what
interest
sense?
rates. By raising interest rates to try to curb inflation that they can't control with interest rates is only going to potentially put the economy in a recession, which is therefore going to give them a stagflation scenario, which they really don't know how to get out of.
What, Vince, but I want to jump in real quick because, and we have plenty of time with you, but I want to push back on one thing. Let's say I'm playing devil's advocate here. The Fed, by raising rates, is essentially going to tamper down demand. So if demand is tamped down, then you won't necessarily see the same push for products, physical and service-oriented products, that you will have seen in a lower interest rate environment. So does that help get the job done?
Well, I mean, the only thing they're going to tamp down potentially is the housing market, which of course is a big part of the economy because it drives, renovations, et cetera, et cetera. But it's not going to stop anyone from going to the supermarket. You're going to you may change your buying habits and buy more chicken instead of steak or something like that. But, it's not going to stop you eating. It's not going to stop you driving because most people drive not for leisure because they have to. It's not going to, raising rates isn't going to curb your energy bill. Or your electricity bill this summer for your air conditioning, certainly not going to lower nat gas prices. I mean, so basically the only thing...
Vince, you might cancel that streaming subscription or a couple of them. You might cancel that vacation. You might not continue that renovation you were thinking about doing. You might not... obviously there's things you're going to have to do to feed your family, but there are things you might back off on it. And doesn't that start to potentially kind of ease some of the demand side of the equation?
Absolutely. But I'm going to curb all of those things potentially if my wages don't keep up with costs. Not because the Fed's raising interest rates. The Fed raising interest rates is going to have, the majority of those people living on fixed income clicking their heels because we saw one of the largest increases in Social Security this year when the BLS raised it by, I think, 5.79%, something along those lines. It was a cost of living increase. No one's going to be getting 6% raises across this country to stay with the cost of living, the 6 to 8%. So if anything, demand is going to be tamped down by, number one, supply being an issue and it's unavailable, and the price, and just frankly because they don't have as much money to spend on what they did before because things are more expensive. But explain to me someone how that raising interest rates is going to fix that situation. It's not going to do anything to help that situation.
I don't disagree with you. I totally get what you're saying. And I think of some of the conversations Tim and I had at Milken, and I really do think, I keep talking and I keep saying recalibration. There are things that are systemically changing, whether it's our energy markets, whether it's chips and everything. And these were trends that were starting. We just had the CEO of the Williams companies talking about energy demands changing pre-pandemic. So things were changing already, exacerbated, by the pandemic. So is this policy that is needed from governments to help with that transition and make it happen more quickly, or what?
Yeah, I mean, look at the two things, or the one thing that's happened during the pandemic and what has happened since basically the financial crisis. What's happened since the pandemic is the federal government put a ton of money into the economy. And, even Yellen at this point has said it's probably contributed to inflation. They've just put too much money out into the hands of individuals, which is where you had everybody saying the consumer is such a good shape in spending. All of that's out there. At the same time, the Fed is raising rates, but they're not reducing their balance sheets that much. There's still a lot of money out there. And when you look at monetary policy, what the Fed controls is not money supply, which is what people think, and they're incorrect. They control what is called the monetary base. So the Fed puts a dollar into the system, and basically based on velocity and how many times that turns over, that's what the money supply is. So the more people are willing to lend from the banking sector, the more people are willing to spend, they take what the Fed has put into the system and increase it or decrease it. So the Fed is basically, unless they really need to cut back on the balance sheet and take money out of the system, not change the price of money. And the federal government, if they're worried about inflation, should be raising taxes, not putting more money into the system at the same time.
It makes me wonder, I can't tell what the timing might be, but will the conversation start to shift to when the Fed needs to start cutting rates again? Just got about 10, 15 seconds.
I think completely, and it may shift a lot faster than people realize if we push this economy into a recession.
All right, Vince, I'm marking the date down, May 5th, 2022, that we talked about the Fed actually cutting rates. Vince Signorella, we love him for many reasons. Bloomberg News Global Macro Strategist Vince Signorella. Check him out at Global Macro Squawk. Just type Squawko on your Launchpad.
Let's get to world and national news. Denise Pellegrini standing by. Hey, Denise.
Hey there, Tim. Thank you. Well, reaction is coming in now from Chief Justice John Roberts to that Supreme Court leak on Roe v. Wade and abortion. And Justice Roberts calling the leak itself absolutely appalling. And Roberts speaking at a judicial conference in Atlanta. Earlier, we heard from U.S. Attorney General Merrick Garland. He was asked what the Department of Justice might do if the court actually throws out the landmark 1973 ruling that legalized abortion across the country.
If the law changes, we will address appropriate next steps at that time. But what will not change is our commitment to defending the rights of women and all Americans.
And Garland says the Justice Department has steadfastly been committed to defending those rights to abortion. Former Secretary of State and former First Lady Hillary Clinton weighing in on this Roe draft, and she says you have no idea who they will come for next. She calls the opinion in the draft by Justice Alito dark and incredibly dangerous. She commented to CBS. A positive update on Secretary of State Antony Blinken's condition following his COVID diagnosis at State Department spokesperson Ned Price's briefing.
He is on the phone. He is experiencing only the same mild symptoms. I expect he'll continue to have phone conversations, speak with staff here, counterparts around the world.
And Blinken tested positive earlier this week, according to Price, and that delayed a key speech on China policy. Meantime, the World Health Organization is putting COVID's death toll in the past 2 years at nearly 15 million people worldwide. That is way higher than previous estimates. Global News, 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Carol Master along with Tim Stenovic here in our Interactive Brokers studio. Just quick update on the markets. S&P 500 down 172 points, a 4% decline. Dow Jones Industrial Average down nearly 3.6%, down more than 1,200 points, and the NASDAQ a loss of 707 points. That, Tim, is a decline of 5.4%.
Yeah, we're seeing among the most read on the Bloomberg terminal, a lot of stories about the way that traders are reacting to today's sell-off. Among the most read includes this story by Valdana Hyrek and Ryan Vlastelic about the vicious rout in stocks wiping out $1.5 trillion and how Wall Street is reacting. Carol, 50 basis point hike. We saw yesterday a surge in equities. Totally different story today. Traders waking up on Thursday deciding that the central bank is going to struggle to fight high inflation amid the lingering threat of a recession.
So this is where we want to know what folks in and around the financial community are saying. So Kim Forrest, she's founder and chief investment officer at Boca Capital Partners, talking to us by phone. The great puking that's happening, I didn't expect that, she said. We live for the days where we've made people money. That's our job, and it's cold comfort that I'm losing people less money. Capital preservation, we've talked about that a lot at Milken.
We're also seeing a lot of other good quotes. This one from Fiona Sincata, senior markets analyst at Citi Index, saying the S&P 500 seeing its strongest gain since 2020 on the day that the Fed decides to hike rates is kind of extraordinary. So we are seeing a reprice today, which is expected. But at the end of the day, the risks remain. Inflation remains high. The Fed, she says, is keen to act.
Also, Dennis Stick, head of market structure and a proprietary trader at Bright Trading, saying there's still a lot of fear out there. People thought yesterday was the green light, but now they're getting caught again. Retail traders keep coming in and getting chopped up. The contrarians have been winning 2022.
I do want to get to a headline crossing the Bloomberg terminal right now. We are learning that White House press secretary, as has been reported, Jen Psaki, is set to depart her role in just a few days. That happening on May 13th.
So here we are coming up on the midpoint of the Biden administration. First term, we often see people kind of move around a little bit. It's a pretty intense job, especially hers, to say the least.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A dramatic U-turn from this time yesterday. The Dow, the S&P, NASDAQ at or near session lows. That goes as well for the NASDAQ 100 index and the Russell 2000. Let's begin with the Russell 2000, down 4.9% right now. The NASDAQ 100 index plunging 5.8%. We've got the NASDAQ Composite Index also down by 5.8%. That is a drop now of 748 points. The S&P is down 186 points now, down 4.3%. The Dow plunging 1,330 points, lower now by 3.9%. 10-year's down 27/30 seconds. 10-year yield 3.04%. Spot gold down 0.1%, 1874 the ounce. Bitcoin down 9.5% right now. West Texas Intermediate crude oil up 0.4%, 108.22 a barrel. The surge in stocks that followed the Fed decision yesterday has proven to be short-lived. Traders are worried that officials could struggle to fight persistently high inflation amid the lingering threat of a recession. S&P on track for its worst session since June of 2020, with just about 97% of its companies moving lower. Among some of the names scheduled to report earnings after the close of trading today, we will be hearing from Zillow, Shake Shack, DoorDash, and Cloudflare. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
The European Union is striving to tighten sanctions on Russia by halting purchases of Russian oil. Now that Germany has withdrawn its earlier opposition, the proposed ban's prospects have improved. Germany's position is crucial because of its influence within the EU, the size of its economy, and its heavy dependence on Russian energy. Its change of heart on oil is welcome, but its efforts can and should go further. Specifically, it needs a plan to shut down imports of Russian gas. Despite what skeptics are telling Chancellor Olaf Scholz, it's feasible to halt German imports of Russian gas this year by increasing imports from elsewhere and reducing consumption. Given the will, the strain should be tolerable in the short term and more than rewarded in the long term. Scholz and his ministers would be wise to take the initiative now. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. As you know, we are seeing selling on the equity side of things, stocks plunging as traders really fret about the Fed's quagmire. I mean, how do they slow down inflation without slowing down the economy too much? And there's lots of concerns about stagflation, meaning that the Fed doesn't get it right when it comes to inflation, but we do see slowing growth. And so the trade, although I will point out, we're starting to see a little bit of buying, so we're just bouncing off our lows of this session. Still down 5% on the NASDAQ, down 3% on the Dow Jones Industrial Average, and the S&P 500 still down about 3.5%.
Really curious to hear what our next guest, Jimmy Lee, has to think about a day like today and all the volatility that we have been seeing of late. He's the founder and CEO at the Wealth Consulting Group. They've got $2.7 billion in assets under management. Jimmy joins us on the phone from Las Vegas. Jimmy, I'm not even going to ask you how you're doing, but I do care. But I'm wondering...
You could be shorting the market and doing really well.
Are you?
Unfortunately, I'm not.
Okay. All right. So I do want to know, what are the calls, what are the emails that you're getting from clients today?
I actually did get one email this morning. I'm actually in Washington, D.C. at an investment conference, talking to a lot of money managers today, actually. A lot of interesting views. But I did get an email that my assistant forwarded to me from one of my newer clients as of the last few years, father of a very big client of mine and a friend, but a little nervous. Told me that if this portfolio hits a certain dollar amount, he wants out. So certainly, retail investors are starting to get nervous. And of course, these last 2 days of volatility I think reminding some people of what it was like March of 2020, and maybe those have been around a little longer, maybe the financial crisis. A lot of volatility the last 2 days, especially when we haven't had a whole lot in the entire year of 2021.
Well, March of 2009, I remember when we bottomed out, and that turned out to be an incredible buying opportunity. And even if you go to March 2020, looked pretty dismal, but ultimately we saw, incredible gains, once we saw all of the assistance, government assistance kick in, and really assistance for different industries to prop up the markets, basically, to be quite honest. All right, you said you're at this investment conference in Washington, D.C. What's the tone and sentiment? We just came from the Milken Institute Global Conference out on the West Coast. A lot of private sector individuals and private market individuals who, yes, were concerned, but certainly not as concerned as those that are in the public market. So what are you hearing, if there's a consensus?
I think the probability of a recession in a lot of money managers' eyes has gone up. And so I think, talked to a couple of fixed income managers that control hundreds of billions of dollars, and a little different take maybe on which parts of the bond market and the yield curve they want to be invested in today. But I think overall, if you're thinking that we're going to avoid a recession, you're probably a contrarian. I still actually think that we could. I know it's probably not going to be very easy. I don't think inflation is going to go away very quickly. But I will say this about volatility, in midterm election years, and we're smack in the middle of one right now, the average decline in the S&P 500, according to FactSet, is a negative 17%. That's the average in a typical midterm election year. Now, I know that this year's a very special. Another fact from FactSet is that after we hit low, which is typically in the end of summer, August, early fall, September,
buckle up.
The one-year return is a positive 32%. So for those of you that are thinking that this could be a buying opportunity, history would support that. Now,
What's most important in terms of market direction, though? Is it being a midterm year? Is it a Fed rate tightening cycle? What is the metric that might determine where we go from here? It's a tricky one.
Well, in my opinion, it's inflation in the Fed. Of course, the war in Ukraine is furthering the issue that we have with supply and inflation, especially with oil and gas, but and some food areas, grains and things like that. But it's certainly for me inflation and the Fed, and that's not positive currently. But this year is tricky for investors because bonds are supposed to give you diversification against equities, and they haven't worked this year, right? So I think this year has shown for us in our portfolios that active investing is extremely important in times like this in both the equity and fixed income markets. And so is the use of alternative investments, having assets that are non-correlated to both bonds and stocks possibly. And so I think asset allocation is more important today than it ever was, even though many people have been poo-pooing it for years now. And so I think we're still up against this backdrop of a tightening Fed and, late to the game in terms of increasing interest rates and fighting inflation and not really, being certain and telling investors what's going to happen once they start selling bonds and reducing their balance sheet. And so there's a little uncertainty there. And it was incredible, that we saw the rally that we did yesterday once Chairman Powell started talking, and then today the sell-off. So obviously, there was a little bit of buying on the dips, but selling on the upside is probably more of a trend that we may continue to see. So I view that we're going to continue to see a lot of volatility, and as some of the issues get resolved, such as maybe the war in Ukraine, who knows when that's going to happen?
Right.
But if we get some resolution there, that's going to take some pressure off of maybe oil. You might see commodity prices come back down. If you start to see some, negative news.
There's a lot of ifs in there.
Well, yeah, but I actually do see it in some areas, right?
Okay.
So, yes, consumers are very strong, a lot of money in the banks. I think people are going to spend like crazy. I've been traveling a lot myself, and the prices for airline tickets, for hotels are very high. I don't think that's going to stop. I think it's going to continue to go.
Right.
And the trend to going to spending on services versus durables, certainly that's there. But
yeah,
I think that if we get some better inflation data, that could look good.
Well, that's what everybody seems to be saying, that if somehow the inflationary numbers start to come down, that certainly would alleviate a lot of concerns by investors as well as the Federal Reserve. All right, Jimmy Lee, thank you so much. Founder and Chief Executive Officer of the Wealth Consulting Group, joining us on the phone from a conference, an investment conference in Washington, D.C. All right, just about 3.5 minutes left in today's trading session. We are seeing a little bit of buying into the close here, but not enough to really turn around the trend that we've seen. We are down almost 3.7% on the S&P 500, Dow down about 3.2%, and the NASDAQ we're looking at about a 5.1% decline as we get ready to really wrap up this session. Right now, though, we're going to head over to our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Taylor Riggs, and Katie Greifeld counting you down to the closing bell. Here to help take us beyond the bell, it's our global simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube on a day, Carol, where we're looking at about 97% of the stocks in the S&P 500 are lower here on the day. This is the fourth time in the past 2 weeks now that we've had a 90% down day on the S&P 500.
Right, we talk about market capitulation. It certainly feels that way when you look at some of these major equity averages and the broad-based selling. But what a wacky turnaround from yesterday when the S&P had its biggest rally in about 2 years yesterday, and now we're looking for the worst session since June of 2020 on the S&P 500. So talk about, Tim, volatility.
Yeah, growth stocks and the NASDAQ certainly taking the brunt of this. The NASDAQ 100 at its lowest level now since March 25th, 2021, having its worst day in more than 2 years.
I know we've talked a lot about the fundamentals. That continues to be the story. I just think a counterpoint to that, Katie, is continued to be our conversations with Alon Rosen, head of equity derivative strategy, of course, over at Oppenheimer, saying that there has been, given the unwind of yesterday, some positioning coming into this, some, dare I say it, some gamma squeezes as you think about some of the positioning, again, that came in, unwinding the big trade of yesterday.
Absolutely. And interesting to hear him say, actually, we're not quite at panic levels. This is still somewhat orderly. I shudder to think what panic does look like.
Yeah, I mean, it is orderly. I mean, when you look at the price action here, that's what you're getting here. But I don't know. I almost think an orderly sell-off is a little more scary than some of the knee-jerk sell-off, because at least when you have those knee-jerk sort of everybody throwing the baby out with the bathwater, you know there's going to be buying opportunities afoot here. Well, I think what you're seeing right now is a lot of people making some very calculated bets about the valuations of some of these names, and more importantly, macroeconomic bets as to how these companies are going to hold up in a rising rate environment. Let's walk you through the numbers, and we're going to go through them slowly here. The Dow Jones Industrial Average is going to finish the day down by about 1,000 points, or roughly 3% here on the day. The S&P 500 is lower by about 152 points, or 3.5% on the day. The NASDAQ Composite right now is going to finish the day down. We're just going to round it up to 5% here, so down 5% on the day, or roughly 647 points. And the Russell 2000, not to be outdone, is going to finish the day down by about 4% here. Now, we're going to get to all those superlatives, Carol, in just a second, but for the most part, everything is pretty much having their worst day, basically since the summer, at least, of 2020, and a couple of cases since March of 2020.
Yeah, and what's kind of wild, Romaine, is just kind of some of the swings that we're seeing on these major equity averages. Even the NASDAQ 100 today, I'm not even going to bring in yesterday and the gains of yesterday, but I mean, you're looking at its low, the NASDAQ 100 was down about 1.4%, or at its high, I should say, at its low, down more than 6%. So just an incredible amount of volatility in the moves today, guys.
Incredible amount of volatility. And if you look on the sector level, it's not pretty. Every single bar on the screen is red right now. If you look at the bottom of the pack, it's auto and components. That's a little bit misleading because most of that loss is mostly Tesla. If you look up at the top of the board, it's a little bit more interesting. I mean, you have some very defensive sectors up there. You have utilities, you have food and beverage, some of these really defensive plays. Those are the least performing sectors today, but still obviously just a wipeout across markets. But Carol, I know you had a very tough job today.
Yeah, finding some gainers, but I found some really good ones, and they held on to their gains by the close, so Romaine's not going to pick on me, hopefully. EPAM Systems gaining about 11% in today's session. Right, this is a name we've talked about. Had a lot of tech workers in Ukraine, got a lot of criticism for not being critical, the CEO or the head of the company, of the Russian invasion. Well, nonetheless, rallying today, top in the S&P 500. They had an earnings beat, and the analysts see the outlook as strong in the face of that war in Ukraine. So this one was up about 11% in today's session. Booking Holdings, we talk about travel. People are traveling. And this one was up about 3.25%, well off its highs, because at its highs of today, up almost 10%, but still holding on to a more than 3% gain. Top in the S&P 500, top in the NASDAQ 100. Earnings last night, stronger than expected first quarter earnings. A big move up in their first quarter revenue. Gross bookings, too, were a big move. And, some optimism from the executive specifically about a busy summer travel season. Hang on, I want to mention Twitter because it was up 2.8%. Elon Musk, this has been one of the big business stories that we were talking about, $7.1 billion of new financing commitments. So more optimism in terms of investors thinking this deal will get through.
Still not trading at 54.20, but thank you.
Not yet.
All right.
Well, speaking of Tesla shares, I should say, down. You did hear Katie mention that they were among the worst performers in the S&P 500. Tesla shares finished the day down by 8.3%. EV stocks getting hit today. Tesla, no exception. Growth stocks in particular getting hit as well. We did learn that Elon Musk has secured that $7.1 billion in new financing commitments. Also want to take a look at Shopify, finishing the day down by close to 15%. E-commerce stocks taking a hit today. Shopify shares trading at its lowest level since April of 2020 after it missed analyst profit estimates and announced its largest acquisition in history. Shopify down more than 75% from its highs back in November. Also keep an eye on shares of Sweetgreen as it does report results in just a couple of minutes.
I love Sweetgreen, by the way.
Well, the markets didn't love Sweetgreen today, down 7.2% today. 46% of shares outstanding are shorted as well.
Really interesting when you think about some of the short squeezes, Tim. Also, as we think about these markets, we have to talk about the bond market. Certainly not as dramatic a day as what we saw within the equity market, but it folds into the conversation about valuations, Romaine, because you have a 2-year yield that's finally back up to a 270, a 10-year yield that's up 10 basis points on the day, the highest that we haven't seen really going out on the long curve since 2018. And therein lies the problem of not just the levels, but the rate at which we've got here. And week after week, month after month of this relentless climb higher, that's certainly been a big story.
And you start to talk about competition, right? I mean, even if you are looking for safety, maybe you are looking for income, you can get it now in a way that you couldn't get it before. You look at that and you compare it to the earnings yield on the S&P 500. You compare it to the dividend yield on the S&P 500, some of the more traditional metrics that folks have looked at to determine whether stocks are valued properly here. And you get a better sense here of why some people maybe are shunning equities writ large right now.
And I mean, I'm just stuck on the fact, I was just checking that if you look at the S&P 500 down 3.6%, that's only the worst close since about a week ago. And I think that just speaks to the type of volatility that we're dealing with, that we have to get used to, that, a 3.6% decline, it's not, the size and scope isn't even that fantastic.
Well, it's not that fantastic, but how many 3% declines have we had this year? Not many. How many 5% declines have we had on the NASDAQ? And frankly, we keep talking about how this is the worst since whatever month of 2020. I mean, if you take out the anomaly of the big sell-off that we had back in March of 2020 here, I mean, these are some of the worst declines, frankly, that we've seen going back to 2008,
just
the financial
put your
crisis.
hand over the chart over 2020.
Yeah, I cherry-pick my time.
I love it.
No, it's just a reminder, though, that as quickly as the market can sell off, it can also rally. And that's the one thing that we can kind of count on, right? We've seen these big swings in either direction.
Yeah, we just spoke
why?
to...
But what would be
Why?
the catalyst? I mean,
Well, I think it's because there's so much uncertainty about, right, the Fed getting it right, the Fed screwing up. Will the economy slow down? Will inflation come down? That's what everybody's saying. Will what the Fed does somehow reduce the amount of inflation? And if that stays out there longer...
There's a lot of... and psychologically,
I don't think
I mean,
so.
you mentioned,
I don't think
maybe it
so.
was Tim that mentioned Sweetgreen. I mean, you talk about the companies and their prices going up, whether it's for their food and their labor costs, and the question becomes, how much more are you willing to pay for your lunch, for your salad? And there's a point for a lot of people where they just say, it's not worth it. I'll just make my own sandwich and bring it to work.
Make my own salad.
Yeah, a demand destruction, absolutely.
Yeah.
Hey, we had a really interesting
Nobody
conversation with
makes their own
Vince
salad. It's a lot of
Signorella.
chopping.
My husband does every single day.
But does he works from home,
Hey,
right?
can I just tell you,
That's
since we're talking Sweetgreen, they just
got free
reported,
time.
and the stock's up about 2.3% here, and it looks like they're reaffirming
Can he make a
their
salad for all of us,
2022
Katie? I mean, since he's
outlook.
making one for
He
you
actually
and him.
buys a huge head of romaine every single week. So.
That's
even gonna
very
go there.
funny. Nicely done.
Tell him to be.
I know that Carol, we have
I'm
DoorDash.
trying.
We have Sweet
Yeah.
Green earnings coming out. I know that you're looking at Sweet Green. DoorDash, at least here, doing much better than expected. Looking at first quarter revenue, people, yes, are still ordering delivery. It would have seemed $1.46 billion versus estimates of $1.38 billion. And demand is holding for some of these takeouts. Again, as sort of a bellwether here for the companies, we thought a lot about growth at any cost and how this company would fare, Carol. So at least that is at least one indication the consumer is still there.
Dash is up, was up as much as 8%, now still holding on to about a 5% gain here in the aftermarket, although it's bouncing around a little bit. But I don't know about you guys, but I order out still a lot.
Can I tell you guys something that gave me a little bit of hope today?
What?
So if you look at the NASDAQ 100, the top performer was Booking Holdings. Obviously, Booking had a great earnings report. It just seemed like a nice little reminder that even in the sort of broad-based sell-off that we saw today, that fundamentals, good earnings reports, they're still going to be rewarded to some extent.
But my question, though, is why does a company like Booking have the rally that we saw today on a down day, and then you had Expedia and TripAdvisor on the same day down 6-7%? What's the difference there?
Yeah, it's a great question.
Is it like kind of, when Lyft reports and it's disappointing and Uber rushes out to, hey, wait a minute, guys, let me just, calm everybody down. Maybe we needed to hear from some of the other players specifically. I do feel like it's stock to stock driven very much in terms of the trade.
Yeah, speaking of that, we spoke to Axel Heifer over at Trivago yesterday. The company hit a 52-week low yesterday after reporting results. Weakness in Europe, and just like people we talked to at the Milken conference, a very big concern about the consumer in Europe.
All right, some stocks bouncing around following earnings in the after hours, including Lucid. It's just down a hair. All right, folks, we got to run. A lot to get to, of course. Tomorrow we'll get that monthly jobs report. We'll be talking about it then. That's going to do it for our cross-platform coverage. Can I try that again?
Go for
On
it.
radio, TV, and YouTube. We'll see
Have you started Cinco de Mayo earlier celebrations?
I keep thinking about the romaine head of lettuce, and I just can't get beyond that.
Yeah, it's going to be in my nightmares.
We'll see you same time, same place tomorrow, everybody.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I mean, it is a good point, like bookings, like what is it? But I mean, they were optimistic about the outlook. That was one of my gainers today. What is it that it doesn't get dragged down in the markets?
Just because I'm hungry, Shake Shack coming out, revenue beating estimates, though second quarter revenue coming in for the outlook coming in a little soft, Carol. They were estimated to see $242 million, only going to see 233.8 to 239.5.
All right,
Stock
take
kind
it
of unchanged in the after hours.
Yeah, not moving too much. All right, let's get back to world and national news. For that, it's over to Denise Pellegrini. Hi, Denise.
Hey there, Carol. More protests outside the Supreme Court today. That's following, of course, the leaked release of the draft decision overturning Roe v. Wade, and U.S. Attorney General Merrick Garland saying the Justice Department will consider next steps if the law changes. He says, though, one thing will not change.
The Justice Department has steadfastly been committed to defending the right to abortion.
And Garland commenting there to reporters. So-called sanctuary states in focus if the draft of the Supreme Court opinion becomes final. More than 24 states are expected to severely restrict or outright ban reproductive rights. And Governor Kathy Hochul says anyone who needs access to care will be welcomed with open arms in New York.
I'm very proud that the state of New York, in anticipation after Donald Trump's election, that something like this could happen. And in 2019, we passed something known as the Reproductive Health Act, which really enshrines in our state law all the protections of Roe v. Wade.
And Hochul commenting this afternoon. And the Pentagon says it is not providing specific intelligence to Ukraine on the location of Russian generals. New York Times story implying the contrary. Ukraine has killed 12 of Russia's generals, and the Times said the targeting help is part of a classified effort by the Biden administration. Here's Pentagon spokesperson John Kirby saying it's not true.
I'm not going to detail the intelligence that we're providing to Ukraine.
Kirby speaking there at the Pentagon briefing. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini here on Bloomberg Radio, and this is Bloomberg.
All right, Denise, thank you so much. We did mention some of the stocks moving in the after hours following earnings. Sweet Green is up more than 2%. Little changes when it comes to Shake Shack and Lucid, reiterating its 2022 production volume, 12,000 to 14,000 vehicles. And just let me pull it up on my Bloomberg. That stock in the after hours is up about 1.9%. In the meantime, another headline crossed.
Yeah, an investor group buying a stake in Funko from Acon Investments. And we're not talking about just any investor group. We're talking about Bob Iger, Chernin, and eBay buying a 25% stake in Funko for $263 million. Shares of Funko in the after hours are actually halted, which is interesting because they did spike more than 40% after this news came out. We should note it's a pretty tiny company, $850 million in market cap. You might recognize the company because it designs those toys, those little bobbleheads that you kind of see everywhere based on characters. You're shaking your head, Carol, like, I've never seen these things before.
No, I know what bobbleheads are, but so that's what it does.
Keychains, pens, pins. Yeah, apparel, accessories, hats.
Yeah, interesting. So $21 a share, 18% premium over Wednesday's closing price. The share is being acquired from Acon Investments along with the new stake. The investors will designate 2 directors, and Chernin and Iger will serve as advisors to the board. Chernin believes Funko has a strong and recognizable brand among consumers, and it's relatively cheap.
Well, they also produce toys that have wide appeal. I mean, like SpongeBob SquarePants and like different characters from
I have one of these.
Yeah, I think you have one on your desk.
No, I don't have one on my desk. I just looked
Which
at
one
them.
do you have?
Okay, please don't judge me.
All right,
but
here
my
we go.
family, after I started watching Outlander a few years ago, bought me a bunch of Outlander merchandise for the holidays because they were having some fun. So I got a T-shirt and I got a little makeup bag that says Sassenach, and I got a little Jamie Fraser doll.
Is Jamie Fraser the Sam Heughan?
Yeah, Hewen is the actor.
Who we've interviewed on our program.
We have. So I have a little one.
So I was going to say,
in my
anyone
closet,
who knows
in my
you,
armoire.
anyone who knows you or listens knows that you're an Outlander fan.
I mean, come on, isn't everybody?
Yeah, that's true.
I'm just saying. All right, anyway, this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Steep losses for the U.S. stock market from Bloomberg World Headquarters. I'm Charlie Pellet. Just a day after notching the biggest rally in 2 years, the S&P tumbled. More than 95% of its companies moved lower. NASDAQ 100 had one of its sharpest U-turns ever. Today, the NASDAQ 100 index was down today by 5.1%. The NASDAQ Composite Index down 5%, dropping 647 points. The S&P plunged 153 points, down 3.6%. The Dow was down 1,063, a decline of 3.1%. 10-year down 24/30 seconds. 10-year yield 3.02%. Spot gold down $3 the ounce to $18.78, a drop of 0.2%. West Texas Intermediate crude up 0.5, 108.38 a barrel. Bitcoin down 8.8%, 36,291 on Bitcoin. Earnings after the bell. DoorDash reported revenue that beat analyst estimates, a sign that customers' craving for the convenience of ordering online has not abated. Even as indoor dining resumes, DoorDash up after hours by about 8%. Shake Shack guiding lower. It sees second quarter total revenue in the range of $233.8 million to $239.5 million. Estimates were for $242.6 million. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, certainly a risk-off trade in today's session. Charlie Pellet, thank you so much for that update. Well, we caught up with our next guest last time on Valentine's Day, one of the big days for anyone in the flower industry. Another big day is Mother's Day, which is this weekend. And I got to say, when we are in a volatile market environment, lots of questions about the economic outlook and what happens next, I really think it's crucial that we reach out to small businesses and business owners. And so this is a perfect guest for us to be talking about right now.
We're talking about the founder and CEO of Farm Girl Flowers, Christina Stembel. She joins us on the phone from Seattle. Christina, great to have you back with us. How are you? Well, thanks so much for joining us. Christina, just give us an idea of what you're seeing. You have such an interesting read on the American consumer because you're seeing what they're ordering, how they're browsing, what they're buying when it comes to Farm Girl Flowers. How is the state of the American consumer right now? Or your customer?
Yeah, it's definitely. Yeah, I think, our customers are really, it's female 25 to 44. It's a very common consumer for e-commerce sales. And so I think we have a good read on what's going on. It's definitely, we've seen softening sales for months now. We're in the midst of Mother's Day and are having actually a much better Mother's Day than I anticipated, to be quite honest. But, I very worried like everybody else and very interested to see what's going to, come with the interest hikes and things like that, as we're already experiencing really intense supply chain issues and things like that.
Well, that's it. That's interesting too. So I want to get into that. You talk about that you've been seeing a softening of sales. So does that mean less people are ordering, or is it a case of people ordering, but they're going for smaller, less expensive options? Give us a little idea, some color on that.
Yeah, that's a great differential. Kind of there's two different things going on. And, so far we've seen just fewer sales, which, a lot of it's attributed to the, new privacy settings and marketing in general has been much more difficult, challenging since they've gone into effect last year.
Wow.
Which we're all, now learning about with Facebook's, reported revenues and things like that. And, so we're seeing a lot less traffic even just coming to our site, and it costs a lot more to acquire customers, much more than it used to. And so we've already had to take a, really good look at things and see if, is it a smarter, is it wiser decision to just cut off marketing or really limit our marketing, which is what we've done, and consciously become a smaller company because it's not worth anymore. If it's going to cost $60 to acquire a customer to spend $90, it's just not worth it. And so, we've already had, been looking at that. And then now, I've done a lot of research, as I'm sure every company is doing right now, at what happened in the last recession. It was before we started in 08. We started in 2010. So, looking at public companies in our space, in our industry, it looks like just what you said. They still have the same amount of sales, but their average order value went down considerably. So now we're looking, what I'm looking to do for Farm Girl is to make sure that we're kind of recession-proofing our business as much as possible. And, what does that mean as far as people are spending $20 less per order and going to smaller sizes? going into 2023. Can we absorb that with such small margins as a company in general?
How do you recession-proof your company?
Yeah, it's a good question. Come back, maybe next year we can talk and see if it works. But some of the things that I'm looking to do is creating products that use less labor. We've already kind of been easing into that with American consumers. It's been hard to find labor at affordable prices, especially we're not a software company. We build products every day, and we rely on wage level and team members, and wages have gone up considerably. And so with having tiny margins with perishability, we've had to already kind of start doing this, but continue to kind of lean into that even more, and doing lower labor options that are still high. We can't do high designs for low prices, and so with higher inbound and outbound transportation costs already going into effect, that we've been experiencing since COVID, we've had to figure out where can we cut some of our costs, and that's not in transportation, it's not in flour costs with supply chain prices going up so much. And so labor is the only thing that we really had to work with. And so we're going to continue trying to tweak that as we go into what could be a recession in 2023.
The last time around, I think we talked about a recent story that had mentioned you about how you were foregoing growth opportunities in an effort to take on less risk. And I feel like it's a theme, and it may be a theme applicable to you and a lot of others in this environment. Is that still the case, though?
Yeah, absolutely. We're fortunate, and I never say this, we're fortunate being a bootstrapped company. I tried to raise capital and couldn't, and got 104 no's. And now I'm actually really grateful for that because, I've been able to make the decision for our company to really focus on profit and not on growth at all costs, which was kind of the, e-commerce, tech company motto for so long. But you can't do that if we go into a recession, right? Cash is going to be king. And so, this year especially really, we became a smaller company last year in 2021, and we continued that into 2022 intentionally because we need to make sure that there's a margin. We can't just go into the red like a lot of companies do to show really great numbers to their investors and boards. We need to have a bottom line, which is going to be really important for companies, I think, going into this next phase.
And at the end of the day, Christina, just in the last 30 seconds that we have with you, that could be better in the long run.
Absolutely. I mean, we forget that most companies in our country are bootstrapped mom and pop, type companies, private companies. And those companies have always had to kick it old school, like I call it, where you have to spend less than you make. And so that's definitely where we're at. And I think companies are going to have to go to that model if they aren't already there.
Well, we wish you well, and really good to check in with you. Like we said, it's talking to small businesses that really give you an idea of what's going on in this economy. Christina Stembel, she's founder and CEO of Farm Girl Flowers, joining us on the phone from Seattle. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so our next guest, Matt, he's invested in some very well-known companies when they were just small companies, if you will, things like American Online, Apple, Audible. He's
Just
also
a few small companies you might have ever heard of.
He's also got a great sense of humor because he's got a new book and he's talking about it, and we're going to get into that in just a moment.
We are talking about Alan Patricof. He's chairman emeritus at Graycroft, also the co-founder of Primetime Partners. He's going to be with us along with his new book in just a few minutes. First, though, Charlie Pellet, let's get a check of everything happening after the market closed.
Indeed, lots of earnings after the bell, but what a day on Wall Street. Stocks went from shaky to unhinged. S&P lower today by 3.6%. Shares of e-commerce companies from Etsy to Shopify tumbled after weaker than expected quarterly earnings, and forecasts deepen concern that the pace of online shopping has slowed. Etsy down 17% today. Shopify down almost 15%. Wayfair plunged 25.7%. After the closing bell, we heard from Block Inc., formerly known as Square. It reported net revenue for the first quarter that missed the average analyst estimate, but after ours, shares of Block up by about 3.6%. Also reporting moments ago, DoorDash. It's out with revenue that beat analyst estimates, a sign that customers' craving for the convenience of ordering online has not abated, even as indoor dining resumes. After our shares of DoorDash, they're up now by about 8%. It was a brutal day for the bulls. Risk off on Wall Street. We had a more than 1,000-point loss today for the Dow Jones Industrial Average. Jimmy Lee is Chief Investment Officer at Wealth Consulting Group. He was our guest right here on Bloomberg Business Week.
Certainly, retail investors are starting to get nervous. And, of course, these last 2 days of volatility, I think, reminding some people of what it was like March of 2020. And maybe those have been around a little longer, maybe the financial crisis. A lot of volatility in the last 2 days, especially when we haven't had a whole lot in the entire year of 2021.
Next up on Wall Street, the jobs report tomorrow morning, 8:30 a.m. Wall Street time. Complete coverage, as you have come to expect over the years from Bloomberg Radio. The unemployment rate, by the way, forecast to fall to 3.5%, along with the creation of 380,000 new jobs. S&P down 3.6% today, down 153. The Dow down 1,063, down 3.1%. NASDAQ plunged 5%. 10-year yield 3.03%. Spot gold down 0.1%. Bitcoin down 8.8%. West Texas Intermediate crude up 0.6%, 108.48 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. Well, with all of the market volatility and macro headwinds facing investors, we have the perfect guest. Back with us is Alan Patricof, you know, an early venture capitalist in companies like America Online, Office Depot, Apple, Audible, chairman emeritus and co-founder of Graycroft. He is also chairman and co-founder of Primetime Partners. He also has a new book out called No Red Lights, Reflections on Life, 50 Years in Venture Capital and Never Driving Alone. He is here in our studio. So nice to have you here. Congratulations on the book.
Thank you.
We're going to talk about that, especially since you've seen so many different market cycles. What do you make of this market cycle and the volatility we're seeing and what feels like extreme selling?
You know, everybody I meet has lived for such a short time relatively in this market that they only see everything going up. And I've lived through so many cycles that to me, this was inevitable. It's going to come. Everybody was living in a euphoric state that things were only going to go up. And I think I said it on this program. I've said it every place. I think that you better be prepared for some kind of hiccup. And I don't know why it's going to happen, but that's just the way the markets work.
How big of a hiccup and how long of a hiccup?
Well, I think it depends on what the afterfall is after this initial setback. You know, will the market stabilize, or is it going to, you know, after a certain period of time, go down again? I mean, the levels that the market's at has just been increasing steadily until the beginning of this year. I mean, last year was dramatic. The whole Trump era was dramatic. I always follow the theory that markets don't like surprises, and all we had was surprises for 4 years. and the market kept going up. So I think we've got an after effect of that. And, you know, I just say one thing, this is not the time to sell. I think you got to ride the rocky periods and watch how and see how it stabilizes.
Even a name like, you know, you've got Meta, Meta platforms, right? You know, Facebook, down about 38% this year. We were talking about Netflix before we got going. It's down almost 46% since April 19th when it just freaked out the markets, right? When it came down with a lack of subscriber growth. So I don't know, how do we make sense of some of that? Is that opportunity to you, or is it like there's something wrong?
Well, if I were following public markets, I'd be looking very carefully for where the opportunities are in terms of companies that have relatively good values in relation to their revenues and their profits, and which ones have the balance sheets that are going to sustain themselves no matter what happens to interest rates. But in terms of Meta and Google and Apple and Facebook, I think we're going through a period where finally the Congress and the Senate are now focused on the monopoly positions that these companies have, and there's legislation pending. And I think that it's been long in coming. You realize that the internet has not had any regulation. There's been no regulation in 25 years. We're living with outdated monopoly laws, and I think that Europe has just passed some very significant laws, and the U.S. is going to follow, I think, very shortly, and that is an overhang.
Very curious about your thoughts on this, because you invest in early stage tech companies and you've invested in absolutely society-changing companies like America Online. Does the monopoly power that you argue that some of these big tech companies have, to what extent does that stifle innovation when it comes to startups?
Of course it does. I mean, you know, I can't tell you the number of companies I've been on the board of where I've gone to a board meeting and they'd say traffic was down 50% or 20, whatever the percentage is. Why? Google changed their algorithms. Yeah. I mean, that's monopoly if I've ever heard it. I mean, our original monopoly laws were related to control of the railroads and control of oil. Now we're seeing a different kind of monopoly control, and that is, you know, when you have 90% of your search going through one vehicle, and when people are putting their own internal products and offerings ahead of other products that are available, that's monopoly.
Consumers get hurt.
Yeah, ultimately, of course they are. Well, let's put it this way. The advertisers are getting hurt. The competitive businesses are getting hurt. And I think everybody is mesmerized by, you know, one-day delivery and getting low prices. But at the same time, it's hurting a lot of small businesses.
Elon Musk and Twitter. What do you think about that? You know, I think that Twitter, we all use it. We are enamored by it, a lot of us.
Or addicted to it.
It worries me. It worries me. One person, this is the major social media communication platform. All of us, maybe not all of us, but a lot of us certainly use it. And to have one person, and this will be a private company also, right. I think it's, again, another element that I would be concerned about. And I think it's also going to be subject to whatever potential government regulation. I mean, he hasn't gone through this process yet. I think that we still may see some headwinds that may slow this down or prevent it. I don't think it's good for society.
Well, and it's interesting, you know, it's interesting that you say that, because we also do wonder, you know, what it means in terms of how we think about media. Like, you know, you've been involved in these tech companies, and that really changed the way we think about media. And I mean, do you see Twitter as a kind of a traditional media company? I mean, so many people get their news from these social media companies. We see the influence, but how do we need to think about them? Are they entertainment? Are they media? Are they what?
Media. I mean, I mean, Twitter has a major influence on what happens. Someone can tweet something, and it can influence the market. And, you know, if Elon Musk prevails, it could very well become the Wild West. And therefore, I think the government is going to, and, you know, Section 232 is something that's very actively being discussed, and I think at some point that will come in and under some kind of regulation. It's been pending for so long.
The Wild West in what sense, very briefly?
That Elon Musk can do anything he wants with it. It's a private company. He could, who knows what he could, I can just conjure up all the things that he might use this for as a personal toy. He's got a lot of money, and I don't know how much he's going to be controlled by these investors that he's getting. It just worries me. I don't think it's good for society that one person controls major media. Just like I think there's a concern about Facebook having the strength it has, and Google and Apple having running a toll booth. All these things are gotten to a point where I think we got to deal with it.
We're going to continue with Alan Patricoff, and when we come back, we're going to talk about his new book. We do want to get into it, and because he has seen, as he mentioned, so many different market cycles and understanding the creation of some incredible companies. So we're going to continue with Alan Patricoff. His new book is No Red Lights, Reflections on Life, 50 Years in Venture Capital and Never Driving Alone. In the meantime, let's get back to world and national news and Denise Pellegrini. Hey, Denise.
Hey, Carol. Thank you. Well, reaction is coming in from Chief Justice John Roberts to the Supreme Court leak on Roe v. Wade. Roberts calling the leak of the draft absolutely appalling. U.S. Attorney General Merrick Garland was asked what the Justice Department would do if the court were to throw out the landmark 1973 ruling legalizing abortion.
If the law changes, we will address appropriate next steps at that time. But what will not change is our commitment to defending the rights of women and all Americans.
And Garland there commenting with reporters. Now, if the draft of the Supreme Court opinion becomes final, more than 24 states could severely restrict or outright ban reproductive rights. But Governor Kathy Hochul says anyone who needs access will be welcomed with open arms in New York.
This has been a battle, my mother's generation, my daughter's generation, and now I have a brand new granddaughter. This should not have to be the fight of her generation as well.
And Hochul commenting this afternoon. In Washington, Secretary of State Antony Blinken is feeling pretty good in spite of his COVID diagnosis, according to State Department spokesman Ned Price.
He is on the phone. He is experiencing only the same mild symptoms. I expect he'll continue to have phone conversations, speak with staff here, counterparts around the world.
And Price says Blinken tested positive earlier this week. And Wall Street bonuses may be about to drop. Ellen Johnson of Johnson Associates says bonuses for some deal makers could plunge 40% this year, but the reverse could be true for traders. They could see a big jump in bonuses as they feast on all this volatility. And now we're going to go to Charlie Pellet for details on the massive losses we saw in Wall Street with a $1.3 trillion sell-off.
Indeed. Stocks plunged today with treasuries in a violent reversal from the reaction to the Fed decision yesterday as traders worry that officials could struggle to fight inflation amid the threat of a recession. Developing story right now, headline from the Bloomberg professional service, Peloton said to be seeking minority investments to shore up its business. That according to the Wall Street Journal, Peloton eyeing a stake sale of around 15 to 20%. Again, that according to Dow Jones and the Wall Street Journal. We had the S&P today down 153 points, a drop of 3.6%. The Dow down 1,063, a decline of 3.1%. NASDAQ plunged 647 today, down by almost 5%. 10-year yield 3.03%. Gold down $3.50 the ounce to $18.77, down 0.2%. West Texas Intermediate crude up 0.6%, 108.46 a barrel. DoorDash reporting earnings after the close of trading, up now by about 10%. It did report revenue that beat analyst estimates. And Boeing's decision to leave Chicago is the latest blow to a city that's already seen its once mighty economy battered by COVID and crime. The playmaker confirming today that it will shift its headquarters to Arlington, Virginia from Chicago. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Sorry, we're actually hearing a story from Alan Patricoff, which we might just actually do on here. Charlie, thank you so much. Alan Patricoff is our guest. You know him well, of course, Chairman Emeritus, co-founder of Graycroft, co-founder of Primetime Partners. He's got a book out, No Red Lights, Reflections of Life, 50 Years in Venture Capital and Never Driving Alone, here in studio. Do you want to tell the story?
Well, you were
I was
asking
asking.
a question.
I saw that you went to Ohio
Yeah.
State. It's where my wife went, and I asked if you're not from Ohio, how you ended up.
I was going
there.
to tell this story because I've told this story many times. If you're at a dinner party and you go around the table and someone says, I went to Colby, someone said I went to the University of Wisconsin, someone I went to Harvard, someone said I went to Dartmouth, and they come to me, they said, and I say Ohio State, it's always the same thing, just what you said. How come you went to Ohio State?
Ouch!
You could go any place, but Ohio State gets that reaction.
The Ohio State University.
The Ohio State University.
So why did you go?
I'm going to get busted when I get home.
Yeah, you are. You are.
No, I went there. Frankly, it wasn't my first choice. I had intended to go to Brandeis, and it was very early on in the history of Brandeis, and it was much more religious orientation when I was going. It was like the second or third class, and I went to a preliminary get-together, and I got scared. I was there all by myself, so there was no one to give me guidance. So I went home and pasted the label over Brandeis and put down Ohio State.
You've done okay.
My
You've
father,
done okay.
yeah, exactly. In spite of that, at least I get a visit from the president of the college every once in a while.
So talk to us about this book. We were reminding you, we talked about this, that when you were on Last With Us, which was a few months ago, you actually leaked that you were coming out with a new book. So why did you write this? Why did you want to finally sit down and do it?
I mean, I've been asked for a long time to write a book because I've been in the business. By being in a business 50 years, you become first you're the father of venture capital, then you're the grandfather of venture capital, then it's the legendary Alan Patricof. So, being a legend, and by the way, this past year, I was awarded the Légion d'honneur by the French government because I started the first venture firm in France. So I'm now a legend in this country, and I'm a Légion d'honneur in Paris. But I wrote it because, for two reasons. One was I thought it might be valuable, and why I gave the title, No Red Lights. I've lived a multidimensional life, and I feel that that's a valuable idea to convey to younger people about don't get lost in your own small world. Be open to opportunities and get involved in politics, get involved in charities, get involved in art. And I've done all of these things, and there's not much that I haven't been involved in or that I'm not open to. And I live a very active, multidimensional life and always have. And I thought that spirit would be valuable to convey. Plus, I saw what was happening to older people who are, kind of checking out because of retirement ages being forced on them at 60, or they've sold their company and they go to Florida and they start playing golf. And I was saying is I started my first company at 36, my second company at 72, and 2 years ago I decided to start Primetime Partners at 85. And I thought that I wanted to be a poster child. I'm now 87. I thought it would be kind of inspirational. I don't want to, overdo it, but that people who might read it say, listen, if this guy can do it, why can't I do it? Why can't I? Maybe if I only inspire one person to say, I'm going to follow that lead and take on some new challenge. Go back in the same business I've been in, only do it all over again.
The subheadline of the book is Reflections on Life, 50 Years in Venture Capital and Never Driving Alone. What do you mean by never driving alone?
Is that everything in life is cumulative. We don't get where we are by doing things by ourselves. I find it's very valuable to always be in partnership with people in whatever you do, and I follow a very collegial approach to everything I've done. And I find it it's a very good practice to be open to meeting new people at all stages. And as I say, life is cumulative, and the people you meet early on in your career, they come back at you again and again. And I can tell you that, which I say in this book, many of the people I met when I was very young in this business are all running some of the major companies in this country, or certainly in this city, but in the country. And I say to everybody, turn to your left and turn to your right. You just don't know where someone's going to end up, and you develop those associations and relationships, and I find that's been very helpful in my life.
Alan, I think many would argue, certainly coming out of the pandemic, and we just saw the speed of change and innovation pick up so much momentum because companies had to for survival, whether it's digitization or, we talk about digital medicine, like just so many different things and how we shop, just so many things kind of just picked up so much momentum. But there was, many would argue, a lot of innovation during what was a very, very difficult time. And I just wonder, when you have looked at innovators over 50 years, like what is it that stands out from somebody, whether it was an Apple or another company, that you just knew that this was somebody or an institution that was on the cusp of doing something very differently?
Well, no one has that much foresight that they can pick winners all the time, because as part of the business, there are a lot of losers in the process. But what you'd like to find is someone who's got a vision and who's passionate about what they do. And I think that is fundamental to being really successful. I mean, Mark Zuckerberg was a perfect example, who was a passionate person. Sergey and Larry were passionate. Steve Jobs was passionate. I think that if you're driven, that has a lot to do with not just knowing the technology, but have a vision of what you want to do. And one of the things that concerns me is I give a lot of lectures or courses at colleges every now and then, and when you ask people in these business schools, how many of you are going to start a business, 3/4 of the class raise their hand, and they have no passion really about what they want to do. They're doing it because someone in the previous class started and made $5 million and sold their company, and they figured, if they did it, why can't I do it? So as a result, they start a new dog watching company or a new delivery company, and so we have a lot of repetition, not as much originality in the startup and innovation as we'd like to, frankly, as I'd like to see. Most things today are applications of existing technologies. There aren't that many breakthrough technologies that are happening. They're happening, but I mean, not.
Metaverse?
Yeah.
Why is that though? Why are we not seeing?
No, you mentioned metaverse. Yeah. I found Jaron Lanier, who discovered
Microsoft guy years ago.
No, Microsoft. Before that, Jaron Lanier was the guy who founded artificial AI. No. Virtual reality. Excuse me, I got myself. Yeah, VR. And I found him at the bottom of the electronics show out in Las Vegas, and sitting at a fold-up desk. That was in 1984, and the metaverse is now here in 2022. So it takes a long time sometimes for these great technologies to evolve. That's a perfect example.
And he's now skeptical of a lot of types of technology.
Well, he's written a book, and actually our meeting is in that book. And I don't know if it's one line or two lines, but a lot of things people take time to evolve, and they don't just automatically happen. And if you don't stick with it and have that vision, it's not going to get fulfilled.
When we were at Milken this week, and we were talking about Milken, because you certainly are familiar, and you were talking about Milken in the early days, but so much the growth of private markets versus public markets. And I do wonder, what you think is the future for public markets. I mean, is there enough private capital to keep startup companies? We see them staying private much longer, giving them a longer runway. Does that continue, and do public markets continue to kind of diminish?
I don't think so.
Okay.
I think you've got to find a way for exit for your employees. I mean, I'm involved with one company I can think of in particular that's a private company, and they're running into the problem that, people have options, and it's great to have these options, but, they're sitting there, and how do you realize on the option they want to buy a house? And you've got to find a way. At some point, you've got to be able, people find they have to monetize it in some way, and I think that's always going to create a demand for companies going public. I don't think we're going to go through a period where people are all going to stay private.
Just got about, go ahead.
No, you go.
Just got about 30 seconds, 40 seconds left here. So I think we started out just crazy market environment. I'm thinking about your book and just life lessons. So in an environment like this, everybody take a breath and pause?
I think you don't get scared in times like this and sell and, run for this is the time when, the drums are playing. You look around carefully to find out where the values may be. And we are going into a more value-oriented era. I've been saying this for a long time. When I started out, it used to be PE ratios. Now it's price times revenue or price times EBITDA.
We might be going back to PE ratios.
Exactly. That's my point.
Alan Patricoff, thank you so much. The new book, No Red Lights, Reflections on Life, 50 Years in Venture Capital and Never Driving Alone. Perfect voice to have on a day where we did see so much selling and a lot of volatility. For Tim Stanovic and the whole Bloomberg Business Week team, I'm Carol Massar. This is Bloomberg.